The world mourns and the markets remain on edge. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking you off to the closing bell here in the U.S. You take a look at U.S. equities right now. We shook off early losses, of course, those geopolitical tensions front and center after Hamas's surprise attack on Israel over the weekend. The S&P 500 currently up about 0.6%. Of course, bond markets are closed today for the holiday, but the ETFs continue to trade. You take a look at TLT, which tracks long-dated treasuries, rising today, catching that haven bid up about 1.9% at the moment. Then you go down the list. Of course, gold also posting its biggest move since July, continuing to benefit from that haven bid as well, up 1.2%. And of course, oil, the energy markets, where a lot of this is playing out. You take a look at crude right now, up about 3.7%, Romaine.
Yeah, there's a lot to talk about here in financial markets because, of course, that is what we do here. But before we continue with that discussion of the markets, Katie, we have to acknowledge the horror inflicted this weekend in Israel. The loss of life, mostly civilians, is gut-wrenching and still rising. The number of people held hostage or simply unaccounted for, heartbreaking. There's a big question now about what comes next, from the pending military operation by Israel's defense forces to the financial and weaponry support from its allies, to a determination of the role of Iran, to the position that Middle East neighbors like Saudi Arabia ultimately take in this conflict. We're going to try to answer some of those questions over the next 3 hours or so, through the lens of business owners, through the lens of investors, policymakers, diplomats, and other stewards of our world economy and our global financial markets. As for those markets right now, as Katie just touched on, the biggest impact so far is showing up in the energy space. Oil futures in New York today surging more than 5% on concern that the Israeli-Hamas war will erode recent gains toward political stability in the wider Middle East. Bullish oil options contracts surge relative to bearish put contracts for Brent crude over there in London, and the difference between the two sides of that option trade, that's known as a skew, on track for its biggest one-day move since March 2022, when oil prices jumped in the aftermath of Russia's invasion of Ukraine. Gold up 1% or so on the day, haven bids coming into the dollar and the yen, and a big flight right now away from emerging market asset funds. There are a lot of individual stock stories as well here on the back of the conflict, Katie, from defense contractors to cybersecurity companies, of course, to just a hodgepodge of companies listed here in the U.S. that have very deep ties to the entrepreneurial landscape over there in the Middle East.
Well, you mentioned defense, and that's what I want to talk about because Goldman Sachs has a basket specifically of European defense companies. That's here in white. You go back since the start of 2022, and this trend has been building for a while. That basket nearly 100% higher since the start of 2022. You think about Russia's invasion of Ukraine, of course, the tensions between the U.S. and China, and of course, now the outbreak of Hamas attacking Israel. And you can see that's been a big benefit for those defense companies, more so than the aerospace and defense industry overall. And of course, you have the MSCI World Index in blue there, which is underwater over that time frame. So European defense companies benefiting. So too is the dollar, again, as investors really search for a haven here. Taking a look at the BBDXY, really since the beginning or about mid-July, it's just been a straight trend upward. That trend is continuing today, Romaine, of course, as the dollar continues to attract investors looking for some safety.
Absolutely. Let's get some insights out of our first guest, Jeffrey Kleintop, joining us right now to kick us off to the close. He's the Chief Global Investment Strategist over at Charles Schwab. Jeffrey, I do want to start off before we get knee-deep here into markets here. Just a little bit of a discussion here about geopolitical risk in the wake of the attacks on Israel over the weekend here, and just the need for markets, I guess, to always be mindful here that there is still a great deal of instability in our world.
There is. Geopolitical risk is an ever-present part of investing, and specific developments may affect markets from time to time. But it's important for investors to know that outside of a recession, it's very rare that geopolitical events have enduring impacts on the markets. As we all know, and as you noted at the top of the show, the human toll is immeasurable, but the markets do a quick job of trying to assess the financial and economic impact. And I guess the take so far this morning is that that's fairly minor. I would point out that there's a lot we don't know. But unfortunately, we have a long history of conflicts involving Israel. 23 of them going back, including many military operations. And what we tend to see is a knee-jerk reaction in the first day or two, and then even just 5 days later, the market's usually back above the levels it was prior to that conflict. Anything can be different this time, of course, but it's important for long-term investors to keep in mind that we have seen these types of events before, and conflict in the Middle East is nothing new.
Yeah, absolutely, and well said here. Of course, everyone's still keeping an eye on the oil markets. Obviously, we know Israel itself not a huge player in that market, but we do know Iran is. And without any speculation here about what their role may have been in this attack, is there any concern here that there could be a disruption of oil supplies?
I guess there's always some risk. Iran has threatened oil traffic within the Straits of Hormuz. I think it was in July where they seized a couple of vessels. One was a Panama flagged vessel, I guess. And then I think the U.S. actually had to fire on some Iranian military vessels that were attempting to interdict some crude shipments. So there is a potential for some stress there. That is where 1/5 of the world's crude oil moves through. So that's a potential threat. But Saudi Arabia has more excess supply than they've had looking back for decades. So should there be some type of disruption, Saudi Arabia does have the ability to ramp up capacity there. Of course, that's the grade of crude that we tend to use in the U.S., sweeter grades of crude. That's what our refiners are keyed towards. So we have that buffer there. And of course, there's U.S. shale, which we know is very responsive to price development. So I think the likelihood of a sustained disruption in energy supply is a fairly low risk.
What about a sustained bid in the bond market? Because again, cash bonds closed today for the holiday, but you take a look at where ETFs are trading, where Treasury futures are trading, and it seems that a bid is coming back into the bond market. Is that a knee-jerk haven reaction, or do you think that maybe we've seen the ceiling in Treasury yields?
Maybe both. I mean, it certainly feels like a knee-jerk reaction here, but there's been such an incredible move in yields, particularly over the last month, just since the beginning of September. It's not surprising to see a little bit of a move back. It's hard to justify where yields are, given the receding inflation pressures, the relatively lackluster economic picture both here and around the world. It would suggest that yields are probably at or near a peak. And so, yeah, it wouldn't surprise me. I think getting some comments from some Fed officials this week, maybe even the minutes on Wednesday, might be interesting to see what they thought of the move up in yields and the potential risk to the global economic picture as financial conditions tighten. So, yeah, perhaps this suggests even more likely that we're near a peak in yields.
Well, looking at recent Fed speak, it seems like at some level they're welcoming the move higher in yields when you think about maybe the monetary tightening that's doing for them. But if we truly are past the peak in Treasury yields, particularly long-dated Treasury yields, what would that mean for the equity markets at this juncture?
Well, certainly longer duration stocks, those companies with more cash flows out in the distant future, they'll benefit because those cash flows will be worth more today at a lower discount rate. I think one of the groups that I'm fascinated has really underperformed this year is those ESG stocks, so those alternative energy stocks. It's not that we've seen, yes, politically, I guess there's been a backlash against ESG, but the trends in place in terms of corporate investment, in terms of government investment, so many of them remain in place favoring those equities, and yet the stocks have plunged really because they're very long duration equities. I think if we did see a turnaround in yields, that could be an area of the market that really comes back here given sustained levels in traditional energy, oil, gas. I think you could see those stocks rebound pretty sharply if we did get a break in yields.
Jeffrey, always great to talk to you. Jeff Kleintop there, class act over at Charles Schwab, helping us kick off to the close here on this Monday afternoon. A somber start to the week as we discuss the latest developments in the Israel-Hamas war. Tina Fordham going to be joining us, the founder and geopolitical strategist at Fordham Global Foresight.
Plus, Port of Los Angeles Executive Director Gene Seroka will join us on the flow of global trade.
And we're going to check in on the real estate market. Compass CEO Robert Reffkin going to be joining us in just a few minutes. All that more coming up in just a bit. This is Bloomberg.
Hamas started a cruel and evil war. We will win this war.
The whole country is still wondering and in shock. It's incomprehensible, and we're still waking up and hoping it's a nightmare.
The Palestinian people, the Palestinian Mujahideen, All Palestinian groups and the Islamic Ummah should be congratulated.
This is Israel's 9/11. This is Israel's 9/11.
The United States stands with Israel. We will not ever fail to have their back.
Israel cannot wage a full-scale war on a nation, its people, its land, its holy sites, and expect peace in exchange.
Hamas and the people who support Hamas are fully responsible for this appalling act of terror.
Israel will do everything to bring our sons and daughters back home.
You're listening there to just some of the global leaders reacting to the deadly attacks by Palestinian militant group Hamas on Israel over the weekend. And for more, let's bring in Bloomberg's Nick Wadhams, who joins us now. And Nick, we've heard U.S. President Joe Biden pledge rock-solid support for Israel. What does that look like in practice?
Well, I think what you're going to see is the flow of some munitions to Israel. We've already had the U.S. announce over the weekend that it was moving carrier strike group to the region to help in defense of Israel. But you're going to start seeing, artillery shells, precision-guided bombs, things like that. Israel makes its Iron Dome system at home, so unlikely the U.S. would provide that. But really, both diplomatic support and then the flow of munitions so that they can keep up the fight against Hamas.
I am curious. There are obviously a lot of people out there, Nick, trying to draw parallels between the support for Ukraine once the Russian invasion occurred here. Obviously, two different stories, particularly given our long relationship with Israel, not just as allies, but within the context of the military and financial assistance that we have been providing them for years, if not decades here. I mean, what more is there, I guess, that we can do that we haven't also already done?
Right. Well, there are a couple of really interesting elements of that to tease out. One is there is not a ton of overlap between the support that the U.S. provides Ukraine and would be providing to Israel, except in the space of artillery shells. So there would be some overlap and there could be some tension there. But the kind of material that Israel is looking for is not typically the sort of weaponry that the U.S. would be sending to Ukraine. The issue, though, is a matter of focus. So we were heading into the whole speaker shutdown and that turmoil in the U.S., where Ukraine funding was very much in the spotlight. Obviously, it's safe to say that the push and pull over that funding between Republicans and Democrats has very much been pushed to the side, as there's a big bipartisan move now to give Israel anything it wants, but then to start also investigating why this attack was such a surprise. So Ukraine was very much in the focus as of last week, and now obviously it is not the highest priority for the Biden administration, and that's going to have an effect.
All right, Nick Wadhams, our man in Washington covering national security for us. We want to continue the conversation right now and get some insights out of Tina Fordham. She's the founder and geopolitical strategist at Fordham Global Foresight. And Tina, let's start off here with the U.S. response. We heard, of course, Joe Biden making it clear that the U.S. government policy is to stand behind and stand steadfast behind Israel here. Do you think we're going to see a meaningful uptick in spending on this conflict relative to, I guess, what we already commit to Israel on an annual basis now?
Well, I think spending is just one signal. I think the more powerful signal, as Nick mentioned, was the relocation of strike carriers to Israel. I mean, that's U.S. security and defense putting its money where its mouth is. I think market participants are really being overly complacent about the geopolitical contagion of this conflict and the fact that it's taking place against a much more complex economic and fiscal policy background compared to 2006. I was at Citi as the chief global political analyst at that stage, and your previous speaker is right that most of these exchanges of fire and other kinds of examples of conflict had a very short-lived impact. But just as we can compare to how we've seen many skirmishes in the Middle East.
Yeah.
We also need to compare how this time is different.
Well, let's talk a little bit more about that, because I am curious, Tina, when we think about past conflicts, and not just attacks on Israel itself, but we even go back to 9/11 here in the States, as well as other conflicts where you had actors in the Middle East clearly trying to pull the U.S., and for that matter, Israel, into these broader conflicts here. And we know in the past there's been a lot of restraint shown. This does feel a lot different, just in terms of the rhetoric that we've heard out of the Israeli leaders just over the last couple of days, as well as their allies here. And we know that this isn't really so much about whether Israel goes into Gaza. A lot of this has to do with what's Iran's role in this? Will there be a direct response to Iran? And what are other allies in the Middle East, like Saudi Arabia, what position are they going to take?
Absolutely right. And that's where the notion of the interlinkage of this crisis is, again, I think, being glossed over by market participants. I talk about the geopolitical risk supercycle and how it's no coincidence that Hamas chose this time to attack. They got very lucky, but also Serbia-Kosovo tensions ramping up, Azerbaijan and Armenia. This is a great time for opportunistic actors to settle scores, gain advantage, etc. I think another point I'd make is that Hamas is starting to act a lot like ISIS, and that factor is also going to have an impact for the response that Israel takes, the kind of vengeance, if you will. They've announced recently that they're starting to execute their civilian prisoners and televising it. Don't underestimate what that's going to do to the scale of the Israeli response.
And Tina, I also want to get your thoughts on the state of intelligence, basically. That's been one of the big topics over the past couple days, is why was this a surprise? And when you think about Israel's response, how does that extend to their surveillance, to their intelligence and those efforts?
Well, this is where PM Netanyahu is really at risk, right? We don't know whether his security services warned of this and his government failed to act. There are all kinds of rumors flying around, but at the end of the day, this happened on his watch. And I doubt he will be able to escape the blame. It's not surprising with that in mind that he called for a government of national unity, and the protests that have undermined support for his government obviously will stop. Reservists are reporting for duty and everything else, because for Israel, like for Ukraine, this is an existential crisis.
An existential crisis. And with that in mind, when you think about the support that the U.S. has pledged, of course, to Israel, how might that factor into the support that the U.S. is currently providing to Ukraine? Is there a relationship that can be drawn there?
Listen, in the case of Israel, there's an explicit U.S. security guarantee. In the case of Ukraine, the U.S. does not have an explicit security guarantee in that Ukraine is not a NATO member state. But in both cases, the U.S. is involved in two major wars, both of which have the potential to become systemic. And that is a word that market participants need to understand distinguishes both of these conflicts from others, like Afghanistan, like Somalia, et cetera, where the U.S. has been involved, meaning there's a transmission mechanism to markets. The oil price, yes, but if Israel attacks Iran, that is a major shock, and one that I don't think that investors are prepared for. We've also got to remember that there isn't a lot of fiscal headroom in governments at the moment.
Tina, really appreciate your perspective on a day like today. Our thanks to Tina Fordham of Fordham Global Foresight. Coming up on The Close, oil surging after Hamas's surprise attack on Israel. We'll discuss the impact on energy next. This is Bloomberg.
All right, a rally in oil today, this after the surprise attack on Israel by Hamas over the weekend. Fear spreading about a potential destabilization of the region and the role of Iran in particular. Joining us for more is the co-host of Bloomberg Markets, the European Close, is Alix Steel. And Alex, let's get right down to it. We know that Israel itself, not a big player in the oil and gas space here, but of course, geographically where they're situated here, any prolonged conflict could potentially disrupt supplies coming from other nations, primarily Iran.
And it's even sort of more branched out than that even. If they're not so rapprochement between Saudi Arabia with the U.S. and Israel, maybe the Saudis won't actually take back those production cuts. That was a rumor sort of circulating very heavily last week that would happen. There's also concerns that there would be a real crackdown on sanctions out of Iran, which means less oil coming out of Iran. They kind of skirted around that for a while, and they're producing 3 million barrels of oil a day. Also, let's not forget the gas market. So Israel is a big gas player. There are also a ton of majors in a Qatar project that share with Iran. So your oil majors with Qatar, Qatar shares that field with Iran. And if that's a disruption, that's a significant issue for LNG and natural gas in the world as well.
Talk to us also about the fact that you saw Chevron basically being ordered by Israel to shut down one of its major gas fields. How typical is that in a situation like this?
Quite. We haven't seen Chevron do force majeure, which is basically they cannot deliver on contracts because of things out of their control, and geopolitical conflict is one of them. Now, it's a small player within its overall portfolio for Chevron, but it's not insignificant. I mean, it's 1.5 billion cubic meters a day of natural gas. It's significant. Now, storage in Europe is almost full. So that's the positive side. However, you get disruptions, you get colder weather in the winter. It's just an ongoing issue that Europe is much more exposed to in that sense than, say, the U.S.
How hard is it going to be for some of these oil majors to, I guess, to remain neutral? We know that they are sort of old saws when it comes to dealing with geopolitical conflicts, but there are a lot of people, and without speculating too much, who kind of feel like this might be a little bit different.
I don't actually know that. I'm not sure, to be perfectly honest with you. I think that if you're operating in the Middle East, when you have an Iran and OPEC and Saudi Arabia tension anyway, I think these are things that you probably calculate. However, I can't help but make the bridge to a potential Exxon and Pioneer deal that we talked about on Friday. That is not exposed at all to these kind of risks. Like, that is a juicy amount of shale that has nothing to do with geopolitical risk. Might have like legislative risk, sure, but very different than this kind of operational risk. But the big majors, this is what they kind of do. This is, I mean, imagine all the companies that operated in Russia or had exposure to Russia that they had to pare back. Like, this is kind of SOP in some respects.
All right, Alex, always great to get insights out of you. Alix Steel, of course, everything commodities in Alex's world, but also, of course, the co-host of the European Close right here on Bloomberg. Let's check in on the broader markets here as we round out the first half hour of the show here. Katie Greifeld, the S&P getting a decent bid on the day. The second line of your screen, the benchmark index over there in Israel, rebounding a bit from yesterday's sell-off. Also seeing a big move today in the shekel once again.
Yeah, that's despite support from the Bank of Israel. You can see the dollar continuing to strengthen against the shekel.
All right, you're saying the VIX elevated here, and of course defense stocks both here and over in Europe getting a strong bid today on this Monday. This is Bloomberg. This is the countdown to the close. A look at the broader markets right now with equities here in the U.S. higher on the day here. The bond market, of course, shut down for the Columbus Day, Indigenous Peoples Day holiday here in the U.S., but the commodity space is open, and there's a lot of activity there. Abigail Doolittle standing by right now with our commodities close.
There really is a lot of activity, Romaine, and to the upside. Overall, the Bloomberg Commodity Index up about 1%, a little more than 1%. Lots of strength in the energy complex on the Israel-Hamas conflict. New York crude up 4.4%. Brent crude, European crude, not a big spread here. So we now have WTI crude back above its 50-day moving average. Last week, of course, there was that big decline after a peak to $95 per barrel. The big question is whether or not we're going to see oil go back toward those levels. Many people are saying that it will depend on what the role of Iran is deemed in this conflict and whether or not they get pulled in. One guest this morning, Luke Hickmore of Aberdeen, was saying that it could also be Jordan and Russia. So if supply comes off the market, we could see a big rally. We don't know if that's the case, and I would actually say technicals may suggest the opposite. Gasoline also rallying, up 2% at the highs, up closer to 4% at that point, the best day since March of this year. And then finally, European natural gas up 15%. You all were just talking with Alex about Chevron being ordered by Israel to shut down one of their key gas fields. Well, that is puts a crimp on the supply for liquefied natural gas. So here we have European natural gas in particular soaring up 15%, the best day since August. Romaine.
Of course, we'll be tracking this all day. Our thanks there to Abigail Doolittle. We do want to pivot from the commodities space and take a broader look at the global economy. The latest report from the Bloomberg Trade Tracker, it actually shows global trade is poised to turn a corner, and the worst of the downturn may actually finally be in that rearview mirror. For a closer look at the trade industry, we're joined by somebody who knows a lot about it. Gene Seroka joining us right now. He is the executive director of the Port of Los Angeles, just a minor port here in our economic system. Great to have you here on set, Gene.
Good to see you.
Let's talk a little bit about kind of the pulse of what's going on in terms of the flow of ships. And are we seeing, I guess, a normalization of activity or something, I guess, different?
Yeah, cargo flow operationally is more normal compared to the way we used to see it. All the vital statistics I look at based on velocity of ships, cargo movement, seem to be in really good shape. But there's still a lot of inventory, Romaine, here throughout the United States. In fact, the Fred data says that we've still got an inventory sales ratio of 1.40, meaning that we've got 40% more inventory behind every retail sale we make. That's got to continue to come down and be worked through the system.
This may be a dumb question, but I mean, looking ahead to the holiday season, is this something, what you just told us, does that impact, I guess, what we're going to see in terms of flows, or have all those holiday goods already made it to our shore?
You'll still see holiday cargo coming through during the month of October, leading just about up to Thanksgiving with the last-minute products that are speeding through market. And so far, all indications are the cargo's getting to market, to distribution and regional distribution centers smoothly, unlike what we recently saw in years past.
Well, when it comes to those elevated inventory levels, is it safe to assume then that we're going to see some hefty discounts to try to clear it out?
If you're like me, you're getting emails almost every day from your favorite retailer. And by Friday, when they say that sale is closing out, it comes around the next Monday again. Realistically speaking, the hotter items, those that are geared towards the kids and the holiday products, will be coming through. But still, working down that older product is important. Imports to the U.S. this year are down about 18% overall. L.A. is very similar right now. And what we can see is the biggest lever to that is furniture. During COVID, a lot of folks bought a new desk, couch, dining room table, large, bulky items that take up a lot of containers. That seems to be one of the main differences now in overall cargo volume on the import side.
So maybe we're still not completely back to normal when it comes to some of those pandemic effects. But it's interesting, Gene, I see that port volumes, they actually increased in August, but demand was still sort of suppressed there. Is that just a byproduct, again, of those inventory levels, or how does that dynamic work?
It is. We had a couple things happen, too, Katie. One is that we finally got our dock workers contract ratified in the month of August, and we saw the retailers, other importers, start pushing their cargo back to L.A. in a little bit larger volume. We'll now, with the September figures, have 2 consecutive months of year-on-year growth, the first time that's happened in 13 months.
Was there any sort of longer-term, I guess, fallout from the disruptions that we saw during the pandemic, where we know that a lot of folks were looking for alternative ports to go into? Some found smaller ports, and whether it's on the Gulf or on the East Coast here. Did any of that stick longer term?
Yes, and it will. History has shown over the last 20 years, Romaine, that when we had certain episodes or shock to the supply chain on the West Coast, in L.A., Long Beach specifically, cargo has found its other way. 4 corner strategies, port diversification concepts, and some of it sticks. A lot will come back, but not all of it. And that's why we're out there campaigning for every pound of freight possible.
I do want to get your thoughts here on just weather conditions. As you know, there have been a lot of areas of trade routes around the world that have been affected by drought, not necessarily in that Los Angeles area specifically here, but we know with the Panama Canal, and of course there's been a lot of discussions about some of the river routes that I know you don't necessarily have to traffic in here, but how severe is that right now, not only in the here and now, but in terms of planning for the future?
It's enough to put yet another important variable in the equation for all these supply chain folks making decisions. We've seen some cargo booked out of Asia that's now coming to L.A. typically would go through the Panama Canal, but concerns about that third lock's draft level and the ability to really fill those ships has folks changing their minds just a little bit. This, too, will be cyclical, but it's just one more piece to this overall equation that becomes so complex.
Well, talk to us a little bit more about that, because extreme weather, we've seen a lot of it over the past year. There's predictions that we're going to continue to see a lot of it. Has that changed how you operate at all at the Port of Los Angeles? Are you hedging or adjusting for that possibility that these events are going to become much more common?
Yeah, Katie, this is one of the biggest focal areas because, as you both know, by 2030, we want to be a zero-emission cargo handling port. And by 2035, we want all those 20,000 heavy-duty trucks to be zero emission as well. That means we've got to produce, store, and distribute greener energy in greater quantities than we ever had before. So this is the work that's taking place every day, whether it's on electricity generation or hydrogen fuel cell capability. We've got to continue to really move at a more rapid pace in these areas if we want to meet those all-important climate goals that we have set.
And I should probably ask you about artificial intelligence. When it comes to your port, is that something that you're thinking about, that you're incorporating into the docks?
Yeah, predictive and prescriptive analytics have been on the drawing board now for several years. And the idea is, how much better can we get at using latent capacity in the port, taking advantage of those gaps that exist today so we can speed even more cargo through? For example, 50% of the truck gates go unused every day at the Port of Los Angeles. Being able to just see around corners a little better and plan for trucks to come in and out at a more frequent pace is something I think we can get after right away.
Jean, it's great to see you. Thank you for stopping by. Our thanks to Jean Seroka, Port of Los Angeles Executive Director. Now, still ahead on the close, U.S. senators are in China, and the country's treatment of technology and chip makers was a topic of discussion. More on that next. This is Bloomberg.
All right, time now for a review from the sell side with our top calls, the big movers on the back of analyst recommendations. And we start off with Apollo. Interesting, a downgrade today to market perform. This over at Oppenheimer, which also removed the price target. Now, the key here is valuation. The analyst says that the shares have traded through the firm's previous price target, a big part of the reason for the shift. Apollo shares had actually jumped over 40% year to date. They're down 1% here on the day. Next up, Royal Caribbean. The price target trimmed just slightly to 123 from 127. This over at Wells Fargo. But the analysts there saying that while pricing and booking trends are expected to remain a bright spot, investors, they're bracing for a more cautious tone on fuel and other costs for the company heading into 2024. The analyst, though, keeping that overweight rating after he said he had a meeting with management that gave him at least a better appreciation of the cruise liner's luxury offerings. Nevertheless, the share is down almost 3% on the day. And finally, let's take a look at ARM Holdings, a host of firms starting coverage of the chip designer, which went public last month. Citi initiating with a buy and a $65 target. The analyst saying ARM can now benefit from providing content beyond mobile phones at higher prices, says sales growth doesn't look too bad either. Shares, though, up about 1% on the day, and those are some of our top calls. We do want to stay in the chip and technology space right now because that was a big topic of conversation when a bipartisan group of U.S. lawmakers went all the way over to China and actually got to meet with Xi Jinping. They had a discussion here about, well, what happens when it comes to the chip space and the treatment of companies like Intel and like Micron. For a broader view on the chip space, let's bring in Chris Danely. He's senior semiconductor analyst over at Citi and actually has a buy rating on Micron. And Chris, let's start there here because I think we all kind of know the AI story. We all kind of know about all the geopolitical issues going on right now between the U.S. and China when it comes to chip production. How does Micron fit in that, and why do you remain bullish on it?
Yeah, so Micron is about 75% exposed to the DRAM market. DRAM is a commodity. And here we are coming out of a very, very, probably too long down. And most recently, TrendForce, which is, I guess, the premier sort of market research company covering DRAM, raised their DRAM price forecast. I think they're up 5 or 10% for Q4 and then up again in Q1. And this is the first time in probably 2 years where we've seen any sort of forecast for DRAM being raised. So with Micron, it's our top pick, actually, and it's all about the DRAM cycle. We think we're at the very beginning of a nice upturn in DRAM.
So maybe an upturn coming in DRAM, but think about the margin story, because Micron, it said that it still expects negative margins for a fourth consecutive quarter. You're a buy rating, but how are you thinking about those sort of factors in assigning that rating?
Yeah, very good question. So it's all about the trajectory, right? Micron guided their revenue up about 10%, and they guided gross margins up, although, like you said, still negative. We think within a couple quarters they'll be positive. There's a few temporary headwinds to their gross margins that should go away within about 6 months. Number one is they're lowering utilization rates, right? Once those utilization rates start to go back up, which should happen in a couple of quarters, then the margins will jump pretty sharply. Number two, they have all this leftover inventory from this long downturn, and they're basically trying to get rid of the inventory as quickly as possible. So they made a few deals and discounts out there. But again, as the DRAM sector starts to inflect, those deals will go away and they won't need to have lower utilization rates. So for a host of reasons, I'd say I've followed Micron and DRAM for about 20, 25 years. This is a very typical trough of the cycle. And, given that semis and really tech stocks in general are fairly anticipatory, it looks like we're going to have a nice, 1 to 2 years of a DRAM upturn here.
And is that a Micron-specific story, or does that extend to its peer group as well?
Definitely the peers. The DRAM space has really consolidated. About 15 years ago, there were 8 or 9 DRAM companies, and now there's only 3. So basically, DRAM has become, the OPEC of semiconductors. And Samsung has about half the market, and then Micron and Hynix basically split the other half. The reason this upturn has started is not necessarily for demand. If you look at the rest of semis, it's not great, right? Handset demand is pretty soft. PC demand is stabilizing, but at a low level. What happened is that everybody, Samsung, Micron, Hynix, they all cut utilization rates. They all cut CapEx. They all cut production. So this is really sort of what you would call a production-led upturn or rebound in the market. And they're all three, after really their worst downturn in 20 years, all three of them said, hey, this is totally unsustainable. We're all losing money in DRAM. Let's cut CapEx. Let's cut utilization rates. Let's cut production. They really did this at the beginning of the year. It took about a couple of quarters to happen. And now we're starting to see the DRAM prices go up.
All right, Chris, great stuff. Going to have to leave it there. Christopher Danely over at Citi, a closer look at Micron and the chip space. We have a lot more coverage coming here on the program, but we do want to go back to the big story of the last few days, and of course that is the attack on Israel by Hamas. We're listening right now to Israeli Prime Minister Benjamin Netanyahu speaking from Tel Aviv. The main headline so far is that Netanyahu is calling on the opposition to form an emergency unity government. Remember, he had trouble pulling together a government now because of some of the opposition there to his policies, but now saying that the opposition leaders there, the opposition parties, should all pull together to form an emergency government, an emergency unity government. You can listen to Benjamin Netanyahu's comments in full. They are in Hebrew, we should point out, by typing in Live Go on your Bloomberg terminal. We'll be back in a moment. From New York, this is Bloomberg.
וצפה בטקס ברית המילה על מסך הטלפון הנייד, וכשנשמעו המילים בדמייך חיי,
Welcome back to The Close. It's time now for our Wall Street Week Daily segment. David Weston on assignment today, so I'm going to do my best impression of him. A focus today on mortgage rates, which are at their highest since December 2000 and have been above 7% since mid-August on average, locking out a lot of would-be buyers and contributing to a shortage of listing. Joining us right now to give us his insights is someone who knows this real estate market better than anyone else. Robert Reffkin is the founder and CEO of Compass, and he joins us right now here in Studio 2. Great to have you here.
I'm glad to be here. Thank you.
Let's start off here. We could start off with mortgage rates. I don't know. There are a lot of reasons why people aren't buying homes right now. I would think affordability, though, has to be one of the bigger ones. When you're so used to being able to go into a mortgage broker or to a bank and get a 2%, 3%, 4% mortgage, and now you're going in there and you're looking at 6%, 7%, maybe even 8%.
Yeah, housing affordability, it's at a 40-year low. You have mortgage applications at a 30-year low, mortgage rates, the highest since 2000, as you mentioned, and you have record low inventory, 4% less than there was this time last year when there was record low inventory. However, we do have what we call the 5 Ds. You have diapers, diplomas, diamonds, divorce, and death. And when those life events happen, it keeps the market moving. And so we're at this current rate of home sales of around 4 million at a seasonally adjusted rate. And I don't believe it's going to go lower.
Give us some sense of how that differs depending on the region that you're in.
Yeah, some markets are doing better than others. I think on balance, the low tax, warm weather states, Texas, the Carolinas, Florida, are doing better than ones that aren't. You have the Zoom towns not doing as well. So Boise, Idaho, Salt Lake City, Utah, not doing as well as markets that are bringing their employees back to the office. Seattle saw a nice boom. San Francisco starting to see a boom there. I think New York City benefited a little earlier than others. Within the markets, if you're a property that's move-in ready, you're special, unique, prime area, you'll sell like that. But if you look like everybody else, you could be on the market for a while.
I mean, Compass obviously has a big presence here in New York. I am curious about the sustainability of the city. There was a lot of discussion during the pandemic, as you mentioned, some of those southern states. Everybody was looking for, I guess, just a different way of living than maybe what you could get here in New York. But I'm wondering also if that has started to flip back. I mean, at the end of the day, this is still, for better or for worse, the financial capital of the U.S., maybe even of the world here. And there is a need for a lot of people to physically be here.
Yeah, there was a 20-year trend towards cities that moved back the other direction towards suburbs during the pandemic. I think we're seeing that return across all of our major cities. And the key driver really is the CEOs in those cities. To what degree are they bringing people back to the office 3, 4, and ultimately 5 days a week? When that happens faster, you see more movement. Where in markets where it's slower, you see less movement.
With the types of activity you're seeing in terms of client activity, is there a noticeable difference in the types of folks that you're dealing with now than maybe a couple of years ago, whether it's in terms of their wealth or their social geography?
Yeah, so the wealthy, the ultra-luxury market is stronger than the lower middle market, and that's because we have this trend line towards people with money generating more money, the rich getting richer. That is happening. That's continuing in this environment, and so definitely the high end is stronger than the, call it, 500,000, the more mortgage-dependent market. The market that's more dependent on mortgages, typically below $2 million, has been slower as rates have increased. That said, the market last fall really went off a cliff around this time of the year because it increased over 100 basis points in just 1 month. The market now is holding strong. We're not seeing the same decline we saw last fall, even with the mortgage rate increase.
I am curious, too, when we talk about the increase in housing affordability, it kind of obscures the fact that a lot of activity in the housing market, at least prior to the pandemic, were either people investing, whether they were just direct investors looking to flip, or maybe folks looking for second and third homes here. I am curious about primary home ownership, meaning the people who are buying a home that they're going to live in and presumably live there for a long time. Are they major players in the market right now?
Yeah, the market right now is a must-move market. It's not a want to move, need to move, or investor buyer move. It's the people that are moving at this 4 million seasonally adjusted rate. These are the people that have those 5 Ds that we talk about that must move. We're just adding on the 5 Ds, people that have to return to office. But we're seeing very, very little optional movement in this market.
With some of the changes that have taken place in terms of migration, people moving to Texas and other areas, do you think some of those changes could be permanent? That there's been sort of this open, people have had their eyes open to say, okay, I don't necessarily have to live here. I can live in this state, have a better quality of life, and at the same time still generate the same amount of income that I would have in this other state.
Yes. Yeah. I think we've seen some people from California move to parts of Texas and want to come back, but some have stayed. We've seen some people, I'm sure you know them, from New York that went to Florida and have returned, but some people have stayed. And some of the actual companies have moved, right? And so some of the investment companies have moved to Florida permanently, and of course, Tesla's moved to Texas. So that has definitely changed. But I expect more people to be moving back than people staying. From the data that we see, and one of the things that is holding people from returning back is they are locked into their home with a low mortgage rate. So, as an example, 30% of homeowners are locked in at 3% or below. You have 70% of homeowners are locked in at 4% or below, and they consider that a financial asset and don't want to lose it. So, if you moved to the suburbs outside of New York, and you thought you were going to be coming into the office maybe once a week, and now your company moves it to 4 or 5 days a week, it could be a hard transition. But now you're locked into your home because of that low mortgage rate. So what we're seeing them do is they're buying in New York City, and they're trying to rent out their pre-existing home and taking the financial arbitrage between high market rents and low mortgage rates.
All right, Robert, this is a great conversation. Great to have you here in studio, too. Robert Reffkin there, the founder and CEO over at Compass, here for our Wall Street Week daily segment. And just a reminder that you can catch highlights from all of our conversations every Friday at 6 p.m. New York time, where you get the full show, Wall Street Week, with David Weston. And David, of course, normally will join us every day around this time. As we head into the final hour of trading here on the close, Romaine Bostick alongside Katie Greifeld. A wild day here in the markets, not necessarily at the top of your screen. We should point out bond markets, as I'm sure you know, Katie Greifeld, are closed today here in honor of the holiday.
Of course, the bond markets are closed, but you can take a look at Treasury futures catching a bid today, that haven bid, of course, as investors seek for some semblance of safety.
A relatively strong showing in the U.S. equity markets, a potential rebound that we're seeing in some of those Israeli markets. Our full coverage here of everything going on in markets and geopolitics after the break. This is Bloomberg. About 3 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Katie Greifeld.
A view from the top here on U.S. markets. Green across the screen for most of the major indices. And a lot of that, Katie Greifeld, seems to be tied to some interesting comments that we're getting out of Fed speakers that I guess might suggest that there might be a little bit of relief coming, at least when it comes to Treasury yields.
Of course, that they might have to be less hawkish. They might have to do less here because yields have shot up a lot. When you think about the costs of funding getting higher and more expensive, the cost of capital, obviously that tightens financial conditions.
Yeah, we should point out, of course, it is officially a holiday here in the U.S. Stock markets are open, of course, but bond markets are closed, though for some reason the TLT ETF continues to trade on.
That's the thing about ETFs. They always trade. If the stock market's open, so are the ETFs. You can see TLT getting a haven bid here, up 2%. We've been talking about the record drawdown for this long-dated Treasuries fund, obviously seeing a little bit of relief today.
And of course, we do have to turn our attention back to what happened over the weekend. You see the last two lines of your screen, at least for financial markets, those were two of the biggest impacts. NYMEX crude up more than 4% on the day, similar move that we saw on Brent crude over there in London. And you continue to see a little weakening in the Israeli shekel there, 3.95 and change versus the dollar here, though we should point out Israeli financial markets, at least the stock market, did rebound just a little bit in the most recent session after selling off over the weekend. Just a few minutes ago, we did actually hear from Israeli Prime Minister Benjamin Netanyahu. He was speaking in Tel Aviv, and the main headline there was his effort here to form some sort of unity government as he formulates his response to the attacks over the weekend. Laura Davidson joining us right now from our Bloomberg Bureau in Washington, D.C. And Laura, what more do we know here about the Israeli response to the attacks?
Yeah, so what Netanyahu said was really powerful words, really very harsh in what he was saying, looking at forming this unity government, looking at a massive counterattack, and said, that they will change the Middle East. So this really suggests a big and powerful response in reaction to the attack over the weekend. What's really unclear is how this plays out, over the next several days. It still is chaos on the ground, and people are trying to figure out, this is sort of a multi-front war that's happening with lots of moving pieces. And, just remembering back to a couple weeks ago, Israel's domestic politics were in all sorts of shambles over the judiciary system. So this is really sort of an about face as they move forward, facing the new reality on the ground.
All right, Laura Davidson out there in Washington, D.C. And, of course, you're looking there at footage that was just aired a little while ago here on Israeli TV and around the world. Benjamin Netanyahu making clear that he does plan to try to form a unity government here. He also discussed some of the ongoing operations already here and responding to launches, not only out of Gaza, but, of course, Lebanon as well. The world remains on edge right now. The world, quite frankly, remains horrified here. But we should point out that the markets at least are taking it in stride. We've talked with a lot of folks already who have made it clear here that typically these type of geopolitical situations in the Middle East tend to have somewhat more muted market impact, but it's really about the response going forward that could be the big wild card. We are 1 hour away from the closing bells. Our cross-platform coverage, counting it down to the close, starts now.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. Romaine Bostick alongside Katie Greifeld. We're joined right now by our colleagues Carol Masser and Tim Stenovic. Welcome to our audiences across all of our platforms on Bloomberg Television, Radio Originals, as well as our partnership here on YouTube here. A look at the markets right now, Carol, on what is, let's just say it, a very somber day here. I don't care what your affiliation is. Absolutely. To see what happened over the weekend. And it did have some market ramifications as well.
No words when there's attack like this and a loss of lives. And we're not over yet, right, in terms of the conflict there in Israel. Having said that, you know, we are Bloomberg and we think about the politics. We think about the impact that all has, certainly on global markets. And it's interesting to see on a day where we certainly did see investors initially moving into some of those safe haven assets, whether it was gold, whether it was the dollar. But here we are now with an equity rally. And it's interesting to see how we are trying to, I would say as investors, try to figure out, okay, where do we go from here as we watch what's going on in Israel?
And one of the big implications of this, of course, is rising oil prices, concerns about broader oil market supply constraints if the conflict does continue to go on. As a result, we saw companies like cruise lines move lower. We saw airlines move lower over concerns about higher fuel prices and canceling flights. Real economic implications throughout many different sectors.
You also saw bond prices rise by quite a bit. Of course, the bond market, the cash bond market is closed today, but we do have Treasuries futures trading. And as of 2:30 p.m., say that again?
Yeah, go ahead, Katie.
Oh, sorry, I heard someone. Anyway, as of 2:30 p.m., that was higher by about 30 ticks. That would indicate that yields are set to open about 15 basis points lower.
Yeah, all right. And we should also point out, too, and again, I think Carol said it best, you know, we are a market show here, and we do try to sort of cover all sort of facets of the market affected by these geopolitical events. And unfortunately, on days like today, it is when you see defense stocks rally hard. We saw that over there in Europe, and we're seeing something similar play out here on the U.S. side. Northrop Grumman shares up 11%, L3 up about 10% here on the day, General Dynamics up about 9%. Is, of course, now everyone focused here on the weaponry that could potentially be needed, depending on what Israel's formal response ends up being.
You know, I think, Romaine, how much we talk about in terms of Fed policy, higher for longer, we're trying to gauge, you know, how much is longer, what does it mean? And I think when we're in a situation like this, we are trying to gauge how long that this war goes on. Does it escalate? Does it start to involve other nations? And that is when you start to think about, okay, there's a much longer and broader impact, and then we have to start assessing what that means for different asset prices, if you will, longer term.
And let's not forget that Israel's a major tech hub in the Middle East, the Ramat Gan region right outside of Tel Aviv, a major hub for years for tech companies. Huge tech companies have come from Israel, including Mobileye, including Waze and more. Interesting moves in the chip market today, in the chip sector, I should say today, given the concerns over Israel's investment in Israel as well.
And not just tech. I mean, we forget Teva Pharmaceuticals. I mean, they have a huge biotech presence and a lot even in manufacturing and some other areas. Huge. Yeah, absolutely.
Yeah, so there's a lot of potential ramifications that are masked here by what you're seeing in the equity market. Of course, the S&P 500 seems more to be responding to what we're seeing out of Fed speak today, which makes sense. Of course, you think about how macro-driven the U.S. equity market is at this juncture. Then you take a look at other asset classes that we've been walking through. It's a different story.
On that, I'm going to leave with what Fed Vice Chair Philip Jefferson had to say, that officials are in a position to proceed carefully after the recent rise in Treasury yields. So a lot to take into account when the market's starting to do some of your job. You know, the Fed has to think about what that means for future Fed policy. All right. Heavy day, a lot more. We're going to unpack the close for everybody. We're going to be back in less than an hour's time on TV, radio, on YouTube, and, of course, Bloomberg Originals. Join us for our simulcast Beyond the Bell at 4 p.m. Wall Street time.
And we continue to count you down to the close here on Bloomberg Television. About 50 minutes until we get to those bells. Let's get some insights out of our next guest. Ben Kirby joining us, co-head of investments and portfolio manager at Thornburg Investment Management. And Ben, we were just speaking with our radio colleagues, and I thought Carol said it best. She brought up some interesting comments by Fed Vice Chair Philip Jefferson, basically saying that, look, he's watching Treasury yields, just I guess like all of us. But more importantly, he kind of says that there's the potential here for further restraint on the economy, even though the rate of inflation remains too high. What do you make of that?
Yeah, thanks for having me on the show. So look, I don't think the Fed needs to hike again. Inflation is coming down. It's still too high, but it's coming down. And with the long bond having moved as far as it has, as you said previously, the market is doing a lot of the Fed's work for them. So at this point, I think it really would be prudent to focus on the 500 basis points of hiking that we've already had, and the Fed balance sheet is also down $1 trillion from the peak. So focus on the tightening that's already in the system, let that work its way through, and let's take a pause and see where we are in a few months.
I know the bond market is closed today, but of course everybody sort of is looking at the yields that you get, whether it's in the Treasury space or even in the corporate fixed income space here. There is potentially, and I use the word potentially, Ben, a lot of money to be made there if you're willing to take that risk. Are you willing to go out and take some of that duration risk right now?
We've been extending duration in many of our fixed income portfolios. So this is maybe sort of zooming back. This is the most attractive market for fixed income that we've had in 15 years at least. And whether it's treasuries with interesting real yields, so yields that are substantially above the level of inflation, or TIPS also sort of providing that real yield, or even corporate credit providing total yields that are competitive with equities. Long-term historical returns. So yeah, we think the fixed income looks attractive. We think adding a bit of duration today makes a lot of sense.
Ben, I'm so thrilled that we're talking about duration because someone sent me a spreadsheet that basically does the math for me, which I love, that if you take a look at 20-year treasuries, for example, just picking somewhere out the curve, if yields rose by 50 basis points, you'd lose about 1%. But if yields dropped by 50 basis points, you'd make about 11%. How unusual is it to see that sort of asymmetry when it comes to the risks?
Certainly in the last 15 years, it's really unusual. Treasuries have had a significantly negative skew for the past 15 years, and now it's a positive skew. So look, cash pays 5%. That's pretty interesting, certainly relative to, again, the last decade and a half. But if you want to play for a bit more interesting, then take a bit of duration. And if we do go into a recession, and typically when you go into a recession, yields will fall by a couple hundred basis points, depending how far out the curve you go, you can really have a hedge for your portfolio to possibly offset likely equity weakness in that case.
And talk to us a little bit about the short end, some of that short-dated paper, because on a total return basis, you take a look at 2-year yields right now, and the yields are so high that you think about sort of the duration risk and what it would take to actually see a loss, and you have to really see yields scream much, much higher here. When you think about that, how are you thinking about that duration risk versus what you can just get by sitting at the short end?
So over a long term, cash is a terrible investment. Cash is the worst thing you can put your money in over a very long term. That said, this might be a bit of a different moment. But look, let's talk about a 2-year yielding 5%. Our Thornburg Strategic Income portfolio has a yield to worst in the mid to high 7%. So by having a bit of duration and a little bit of credit, you can get an extra 2.5% or even 3%. Carry over that time period. Mm-hmm. And again, if we do end up going to a recession, then you're going to get the benefit of that duration helping you on the defensive side. So really to us, cash looks okay, 2 years look okay. Our portfolio, we think, is positioned to actually outperform in a variety of those scenarios.
Ben, I do want to get your thoughts here on the equity space and specifically some of the names and sectors that you might find attractive. And I want to start off here, just given just sort of all the concerns right now about geopolitics. Is there anything out there in terms of equity investments that might provide investors some modicum of safety, some potential hedge against some of these geopolitical issues?
Absolutely. So I think our first thoughts are certainly with the victims and certainly a tragedy. That said, from a financial market standpoint, the initial transmission mechanism really is into the energy markets. So having exposure to some integrated oil companies, some companies that have both production and refining, they have LNG, they have some renewables. We think that's a pretty interesting hedge today. And what's interesting is you don't pay a lot for that hedge. Actually, they were pretty attractively valued stocks even before this. So Total Energies is a big holding in many of our portfolios. It's a French integrated oil company, and it has a 5% dividend yield. It's trading at a single-digit PE, and they're also doing a lot to move forward the energy transition. So attractively valued stock, we think an interesting portfolio position, especially right now.
Does that logic extend to the actual commodities market itself, or would you rather play this through equities?
So the equities over time will be correlated with the price of the commodity, but with the equities you get the benefit of that dividend yield. So even if the price of oil is flat, companies that are paying a 5% dividend yield and they're also potentially buying back some shares, you're going to be able to make money even if the oil price doesn't go up. And if the oil price does go up, then you're going to make even better profit. So we like owning the actual equities more than the underlying commodity.
Ben, gotta leave it there. Really appreciate your time today. Our thanks to Ben Kirby of Thornburg Investment Management. Now, coming up on The Close, we'll speak with a former United States ambassador to Israel about the war in the region.
Plus, Nelson Peltz doubling down. The activist investor saying that he's seeking several board seats on Disney's board. We'll discuss the future of the entertainment giant.
And we'll count you down to the closing bell with Barry Bannister, Stifel Chief Equity Strategist. All that and more coming up. This is Bloomberg.
A day of relatively modest gains here in the market with about 43 minutes until we get to the closing bells here on this Monday afternoon. Some of the big cap tech names are doing what they're supposed to do here, but you're going to see a lot of energy names at the top of the list here on the day, a lot of defense contractors as well because of the situation in Israel. To the downside, it's actually a hodgepodge of consumer companies as well as companies tied to the idea that consumer spending might be slowing down. The net effect of it all, though, is a market that is in the green, but certainly a market that still remains on tenterhooks. An S&P 500 up 0.6% on the day, but at 4,300, still potentially going to test some of those key moving averages. And I'm talking about to the downside, looking for more of a conviction to the upside. Not really going to find it on the NASDAQ 100 either. Up 0.5% here, but remember, this is a complicated week, complicated by the geopolitical situation, of course, that unfolded over the weekend, complicated by the inflation picture that we're going to get an update on when we get the CPI data, and of course, complicated by the earnings situation as earnings season officially starts this week as well. United Airlines, in fact, most of the airlines really down hard here on the day. We're going to get airlines earnings this week. We're also going to get some bank earnings as well. Meanwhile, it's oil stocks, oil services companies like Halliburton, as well as defense companies like RTX, as well as General Dynamics and Lockheed that are leading things to the upside. Let's bring Abigail Doolittle into this conversation, as we do every day at this time, for our Options Insight segment. And Abigail, you've been taking a look at a lot of the moves we've seen across a lot of different asset classes, and you've honed in on one, and that's gold.
Gold, indeed. We'll be taking a look at that in just a moment, Romaine. Up on the day. Lots of perhaps surprising moves to folks today. One of them is not happening, though, and that, of course, is for U.S. Treasuries. We don't have a tell from that haven asset class because the Treasury market is closed for the holiday. But TLT, the longer dated Treasury ETF, it's up more than 1.5%. Its best days in August, suggesting that there is a haven bid there, similar to some of the global bonds out there. To talk more about some of these asset classes and what it could mean for gold, let's talk to Carley Garner of Decarley Trading. Great to have you with us, Carley. And so what are your thoughts here? I know that you don't really think about TLT per se, and knowing that the bond market is closed, but I know that you really have your eye on rates.
Right. Interest rate futures markets are open, and we're seeing a nice bid on the 30-year and the 10-year note future, and we're seeing the same type of price action in the options. The reality is, unfortunately, due to the events that occurred over the weekend, the world is just a completely different place today than it was just a few days ago on Friday. And I think it changes the investor mindset. I think it also changes the mindset of some of the Treasury shorts that had been piling onto their positions. Suddenly, there's recognition of some upside risk in Treasuries, and I would have to venture to say that personal investors or individual investors are probably looking at that yield and that safety in the 10-year note and 30-year bond is something a little more attractive today than it was Friday. We're seeing the same thing in gold. Nobody wanted to own gold last week. It was in free fall for most of the week. It stabilized on Friday. But again, today is a much different day than that we were facing just a couple of days ago. The mindset's different. Risk off is a little more in the forefront. And gold did manage to hold support levels last week around 1830. And gold was the number that we had drawn in on our charts that shows an uptrend that dates back a year and a half or so. And we managed to hold that. And today we're bouncing very nicely towards the upper end of the range.
Well, it's interesting, Carley, because in some ways at this point, it's almost an everything rally. We have stocks higher, we have gold higher, we have oil higher, we have natural gas, especially European natural gas, absolutely soaring. One thing that's not higher, though, is the Bloomberg Dollar Index, down modestly, down about 0.1%. How do you tie in the dollar to what we're seeing, and what are you looking for the dollar, knowing that it's a key driver for some of these other asset classes we're talking about?
The dollar index closed higher 11 weeks in a row. That in itself is arguably unhealthy. And so we knew something was wrong. Our best explanation is the capitulation that we saw in treasuries was forcing the dollar higher. If interest rates stabilize, like I think that they are in the process of doing, the dollar should roll over and we should get some relief there. A lower dollar is going to help everything out. Treasuries, stocks, commodities. And yes, I do believe treasuries and stocks can rally together.
So in terms of gold, it sounds as though this is an area that you think is an interesting one to play to the upside. And I think seasonally this is a good time for gold. I could be wrong. You can correct me. But how do you trade gold here?
You're absolutely right. The last 5 years, we've seen really big flushes in early October, followed by several weeks of gains. So I like using options, the February options. You can buy a bull call spread using the 1925 call, selling the 2000 call, and then selling a 1775 to put to pay for it. You should be able to get in for less than $500. The margin's about $5,000, and you have unlimited risk below the short put. But it's a nice way to give yourself some room for error and still participate in the upside.
Wide-ranging perspective on a number of asset classes. Carley, Garner of Decarley Trading, thanks so much for joining us for Options Insight today. And from New York, this is Bloomberg.
This is the close here. Just a little bit more than 30 minutes until we get to the bells. A market here in the U.S. that has actually been trying to put together a relatively decent rally here on the day. Fractional gains, to be sure, Katie Greifeld, but I think some people will take them. We should point out volume a little bit off on the day. We should point out it's still kind of a quasi-holiday here where you have the stock market open but the bond market closed.
Yeah, and you take a look at the S&P 500 right now. This would be a second straight day of gains. That's after a pretty big rally that we saw on Friday, up 1.2%, breaking that 4-week losing streak. Of course, the bond market is closed, as you mentioned, but you take a look at futures trading. Looks like yields indicated to open about 15 basis points lower at this moment. If that's the case, obviously that would be a relief for the equity market.
Yeah, absolutely. Here, as far as what's moving here on the day, you see at the bottom of your screen there a big focus right now on some of the defense contractors here. 1, 2, 3, 4, 5 of the top names in the S&P right now on a percentage basis. Well, they are defense stocks, and the next 5 stocks in that space right now, primarily energy and a couple of material stocks as well. That's basically what's moving us higher. In fact, you go through the top 20 performers here in the S&P today is basically defense and energy.
And that's the playbook, right? I mean, it's defense, it's energy stocks, it's bonds. In particular, take a look at Lockheed Martin right now. That's one of those names, up almost 8.8%. You can round that up to 9. That is the biggest gain since October 2022. So again, the biggest rise in over a year. And you saw the same thing in the European market too. It was all of those defense names.
And we should point out, too, when you look cross-asset-wise, obviously a lot of activity in the commodities space. Of course, energy futures pretty much across the board. WTI here, Brent over in London, natural gas over in the UK, all rallying hard on the day because of concerns here about a potential disruption in supplies.
And it is interesting to see the action in the VIX because, of course, this isn't really a U.S. equity market story. You see U.S. stocks on the rise, but even still, you see a little bit of a bump higher in the VIX, currently trading with a 17 handle.
All right, a lot more to cover here. Romaine Bostick alongside Katie Greifeld, counting you down to those bells right here on the close on Bloomberg. This is the countdown to the close. About 30 minutes left to go here in the Monday session, Katie, and at least for U.S. equities, not actually a bad day.
Not a bad day, at least if you're judging by the S&P 500, currently about 0.6% higher. And you're looking at a pretty broad rally, especially if you take a look at the sector level. You can see Right at the top, of course, it's energy stocks, up about 3.6% for that sector. Of course, after Hamas' surprise attack on Israel, industrials too, real estate, communication services, all up more than 1%. You look at the only sector not in the green right now, way at the bottom of the screen, it's consumer staples, but only off by about 0.1%, Romaine.
Yeah, we're going to talk a little bit in just a second here about the market impact coming out of the fallout from the Israeli-Hamas war. But I want to start here at the bottom of the screen here. Two interesting individual stories. First with WW International, the company formerly known as Weight Watchers. Oprah Winfrey, who's on the board, got into a little bit of a pickle where she actually had some disparaging things to say about these new GLP-1 weight loss drugs. Of course, we know Weight Watchers already said that it plans to maybe sell those drugs. And so she had to walk back her comments just a little bit here and basically say, okay, yeah, she does support this. You're seeing the shares get a little bit of a pop here, up 12% on the day. Meanwhile, 23andMe, now a penny stock and moving even lower, down 6%. And this is after we learned of a major hack that apparently occurred on 23andMe, where a lot of folks' genetic information, as well as other sensitive information, was apparently stolen. It's not quite clear exactly where that information is right now, whether there's been ransom being demanded, and exactly how 23andMe is responding to it. But investors who already had some concerns about this stock prior to the disclosure of this breach now really sort of shaken. Let's go back up to the top of the screen here. We have, of course, a big focus here on a lot of the stocks that are either based in Israel or are listed here in the U.S. but have operations in Israel. Teva just emblematic of them. Most of them down pretty significantly here on the day. Includes names like Mobileye, includes names like SolarEdge, and quite a few others. And then, of course, the defense stocks, both in Europe and here in the U.S., continue to rally. General Dynamics up about 8%. In fact, of the biggest movers in the S&P 500 today, about 5 of the top 10 ones right now are U.S. defense contractors. The other fallout, of course, has been in the FX space. We saw the shekel weaken right now, at least on this day, by the most that we've seen at least in about 3 years. And in fact, right now, at its current level at 395 and change right now, that's the lowest level, the weakest level we've seen for the Israeli shekel versus the dollar going back to 2016. Of course, that is not exactly surprising, given some of the uncertainty right now surrounding not only the fallout from the attack, Katie, but more importantly, the response that we could potentially get, a more forceful response that we could get from Israel in response.
Well, let's talk through that now, because still an unknown number of Israelis have been captured and are presumably being held hostage after the invasion by Hamas militants over the weekend. Israeli media have reported that the number could be at least 100, including elderly people and children, making the country's response more complicated and potentially more deadly. Joining us now is Edward Djerejian, former United States ambassador to Israel and senior fellow at Harvard's Belfer Center. And I want to start there with Israel's response, because we heard from Prime Minister Benjamin Netanyahu recently, just in the last hour or so, who said that the retaliation has, quote, only started, and what we will do to the enemy will echo down through generations. And if that's the case, talk us through the broader implications for the broader Middle East region.
Well, Israel has begun its massive retaliation, as Prime Minister Netanyahu has stated. The big question is whether there'll be a major ground offensive by Israeli troops into Gaza in order to, as the Israeli government has said, dismantle Hamas. That's a huge undertaking, and there'll be much more bloodshed on all sides if that is done. One inhibiting factor that you've also mentioned is the fact that there are approximately 100 Israeli hostages, and Hamas has already threatened to kill some of those or all of those hostages if Israel ups the ante. So the Israeli government is in a very delicate decision-making stance now on how to balance all these factors on the decisions it's made. But allow me to make a larger point here. Mm-hmm. And that point is that this is the 5th war between Israel and Gaza and Hamas. Israel left Gaza in 2005 under Prime Minister Sharon, and Israel then developed a deterrence policy against Hamas. That deterrence policy has failed, in my eyes, with equal consequences to the intelligence failure of not foreseeing this, the scope of this attack. So that deterrence policy is what's going to be the end game here? After all the bloodshed and military operations, are we going to go back to the status quo ante? I doubt it.
I am curious, Mr. Ambassador, and this is maybe a sensitive question here, but when we talk about securing Israel, meaning preventing these types of attacks, and you think about the deterrent system and the deterrence policy that's been in place now, is there sort of, I guess, a dialogue that might be able to take place in the open here about, I guess, more drastic action, meaning seizing more land?
You mean by Israel seizing more land?
Yes, Israel, yes.
Well, that is one of the options, is that if Israel decides to reoccupy Gaza, as I said, they left in 2005, that will be a major decision which will have very, very serious consequences, not only for Israel and its society, but also in the region as a whole. And it could be a very disruptive factor in regional stability. So that's a very far bridge if they take that route.
I am curious. You have obviously been involved on the U.S. side in the Foreign Service as a diplomat, as an ambassador for years, and you've had the ears of presidents and other important decision makers here on the U.S. side. And I am curious, if Israel did push for something that drastic here, how cooperative do you think its primary allies, and I'm primarily referring to the U.S., would be in that type of scenario?
Well, I think there'll be very important strategic discussions between the U.S., Israel, and other powers in Israel if such a step is taken. Let me make a larger point. When I was ambassador to Israel, I was having a discussion with the late Prime Minister Yitzhak Rabin. He was Prime Minister when I was there. He was a man who fought all of Israel's war, a military hero, who was assassinated because of his quest for peace as a statesman after he became prime minister. But he told me that there is absolutely no military solution to our struggle with the Palestinians. There has to be a political solution. We have to put in place a framework for peace and work toward that. It's the only way out. And certainly what we're seeing is that the current deterrence policy of Israel, as I stated, has failed. The intelligence has failed.
Right.
And therefore, there has to be a reassessment.
But I'm curious, when you say a political solution, I mean, who are the Israelis actually going to negotiate with? I'm just, and I don't mean that as a flip comment, but when you think about who's leading the Palestinian territories, when you think about the influence of Hamas, as well as a lot of other actors outside that region who, for whatever reason, want to have their finger in this, I just don't even know who Netanyahu and his folks sit down with and talk to.
Well, there are two questions here. Is Netanyahu's government capable and ready to negotiate with the Palestinians? This is the most right-wing government in Israel's history, which has ministers who don't want to negotiate one iota, 1 inch of Palestinian territory. In fact, a couple of them want to annex that territory. On the Palestinian side, you have a very weak leadership, as you noted, that's divided between Hamas and Fatah. But there has been a negotiating party. We created that after the Madrid Peace Conference, the Oslo Accords. It's called the Palestinian Authority. But they're weak. So I'm not saying this I'm not working in illusions here. Right now, the prospects of negotiations are nil. But what I'm saying is that once we get through this bloody episode, going back to the status quo ante of military responses and retaliation and intermittent warfare is not going to work. It's not going to solve the problem. So somewhere down the road, we're going to have to get to the negotiating table. And there has to be a framework for peace. And believe me, we have worked on that in Democratic and Republican administrations. The framework for a settlement is there, but we have to get the parties to agree to get to the table.
Unfortunately, we have to leave it there. Really appreciate your time today. Our thanks to former U.S. Ambassador to Israel, Edward Djerejian. Coming up, activist investor Nelson Peltz is hoping to reshape operations at the Walt Disney Company by boosting his stake in the entertainment and media giant. It's our Stock of the Hour up next. This is Bloomberg.
Welcome back to The Close. It's time now for our stock of the hour, a closer look at Disney. Activist investor Nelson Peltz seeking several seats on the board, according to sources here. A lot of concerns right now here about what this can mean going forward. Geetha Raghunathan joining us right now, U.S. media analyst for us here at Bloomberg Intelligence. And I thought we were done with the activist investors here in Disney. What's going on?
Yeah, so this is really the sequel. Obviously, Peltz, when he made that first run with the proxy battle back in January, he got pretty much what he wanted, right? He got $5.5 billion in cost savings. He got a whole reorganization. He got a commitment from, Bob Iger to kind of look at all of the assets really closely. But I think he's been really frustrated with kind of how the stock has performed. It's down about 25%. After he kind of ended that proxy fight. And I think that's what he's trying to do by coming in again here to see how he can kind of pressure the board to probably really start kind of looking at carving out, the assets.
And you take a look at Disney shares today, they're currently up about 2.2%. Should we read into that at all about what shareholders might want?
I think shareholders are kind of really viewing this as a pretty positive move. I think this is a fresh set of eyes, and it definitely puts additional pressure on Disney's management to really get things going. We already know that Iger has said that all options are on the table when it comes to the linear TV networks. They're looking for a strategic partner for ESPN, but they really need to hurry up. And I think because ultimately that is what some kind of asset sale, some kind of corporate restructuring is needed to kind of drive the stock higher and to drive an expansion in the multiple.
I'm curious, how much of this is about, I guess, overall Disney strategy, and how much of it is personal, is about Bob Iger?
I mean, I think they're both very closely interlinked. Obviously, a lot of the success at Disney can be attributed to Bob Iger's vision for the company. And he's really going to do a lot of that going forward as well. He has a lot of different strategic priorities, near-term priorities, which include Hulu, which include, again, finding that strategic partner for ESPN, which includes the linear TV networks. And then they kind of outline their much longer-term vision for, the parks business, which has really kind of become the main bread and butter for Disney. So it's going to be interesting to see how that plays out.
All right, Geetha, going to have to leave it there. Geetha Raghunathan over at Bloomberg Intelligence. A closer look at Disney as we continue to count you down to the closing bell. Barry Bannister up next. This is the countdown to the close. Romaine Bostick here, joined now, as she does every day at this time, by Scarlett Fu. Scarlett, if we take a look at the broader market here, we kind of came in today and it was a pretty bad open. It looked like this was going to be a down day, and at some point, I'm not sure exactly why, stocks just decided enough already. Now everything is pretty much in the green.
Yeah, I mean, you look at this market and you wouldn't realize that a new war basically just started. TLT, which is the ETF that tracks long-term treasuries, is still up. So there is that flight to safety taking place. It's up the most in 6 weeks. But really, it was Fed speak that turned things around. Acknowledgement that this unrelenting rise in yields has tightened financial conditions enough that maybe some of the work has been done for the Fed. Still, you see oil moving up by more than 4%. I'm kind of surprised it's not more.
Yeah, well, we'll see. I mean, it's still early. We don't want to speculate too much, but, a lot can change, of course. Yeah. But that is a knee-jerk reaction. And I'm glad you brought up financial conditions, because we were taking a look at that chart last week. When you look at the main indices that track financial conditions, the Bloomberg Index, JP Morgan Index, Gold Index, those financial conditions have eased pretty dramatically. Have tightened pretty dramatically here. And that's exactly what the Fed wants. And it does get to the idea, and I think Philip Jefferson's comments this morning seem to kind of get at that, is that the market's done a lot of work for the Fed here.
Right, and maybe the Fed doesn't need to raise by 25 basis points, but that doesn't mean that any kind of easing in rates is coming anytime soon either.
All right, let's see what Barry Bannister thinks. He's Stifel's chief equity strategist, joining us right now to help us count down to the closing bell. And Barry, I do want to start with the Fed here and some of the comments that we've gotten, not only today, but really over the last couple of weeks, where the Fed actually seems to finally just be acknowledging what I think a lot of us knew, which is that a big part of the disinflation story, a big part of the market story right now, is that the market has done a lot of the heavy lifting for the Fed and its fight to tighten financial conditions.
Well, the market has, with the real yield, the real 10-year TIPS yield has gone up quite a bit. I remember, when the Fed first started this process of raising rates back in the spring of 22, we were about 1.3% negative real rates. So you were getting a negative real return for 10 years. Therefore, even an infinite PE ratio looked attractive relative to that. Now it's a different story. You're pushing 2.5%, and therefore the market did a lot of the work for the Fed.
when we talk about, I guess, what comes next, or more importantly, I guess, Barry, what investors want to come next or what they're planning to come next here, is the idea that have folks gotten comfortable enough with the idea of higher rates and that those higher rates are basically here to stay, at least for the foreseeable future?
Well, debt's only unsustainable when the rate is above the nominal growth of the economy. So R minus G is the concept. We're not there. The nominal GDP of the United States and the interest rate on the Treasury average curve is pretty much in line. So we're okay there. I do think that the 10-year yield is peaking here and has peaked, actually, just under 5. I look at where the 10-year tips should be, the real yield, relative to what's called R star, the neutral rate, or the potential GDP of the United States with other adjustments. I look at the break-even 10-year inflation. At $88 oil, it should be around 2.5. So 2.5 plus 2 plus or minus a half a point. You're at 4.5 plus or minus a half a point. We're there. So the 10-year yield is peaking. And the damage to the PE ratios, the correction, the double-digit correction in that third quarter, I think it's over.
Barry, I want to ask you about oil, because oil prices are certainly climbing today on the news over the weekend, yet it can be argued that it's not actually that high. It's only back up to last Wednesday's level. Of course, as Romaine was just saying, it's still early days yet. We don't know what will happen going forward. How does this affect the debate and the understanding of inflation right now if oil prices do stay at these levels?
Yeah, that's a great question. I mean, I think the events in the Middle East are fairly significant. Iran succeeded, unfortunately, in what they were seeking to do, which was disrupt the Saudi-Israeli peace process. As part of that, there were rumors that Saudi would increase its oil output to achieve U.S. security guarantees through the U.S. Senate. I don't think that's going to happen now. I think Saudi will probably step back and wait for things to settle down. And given the war aims of Israel, which are, extensive, of course, it's going to take a long time to prevent this kind of threat from happening again in the Gaza. So we're looking at oil higher for longer, and as a consequence, inflation a little bit higher for longer, and no real Fed relief. So the Fed's going to stay tight for a long time. It's only when employment gives up the ghost and you start to see unemployment rising that you would actually, I would call a recession, but that would have to be around 4.4 on the unemployment rate. We're at 3.8 now, and I just don't see a recession anytime soon.
Well, not with the job market the way it is. You mentioned how the 10-year yield may have peaked. We're looking at TLT, the ETF that tracks longer-dated treasuries, rallying today. But overall, we know that the price action in treasuries is increasingly positively correlated with equities. So if treasuries is not necessarily a safe haven anymore, does that make oil more of a safe haven?
Well, there are those who think that commodities, be it oil or gold, are a bit of a hedge now that you used to get with high-quality U.S. paper or German paper in the past. I could see that. I mean, I certainly understand that argument. We're bullish on commodities for the better part of the next decade. But nothing, nothing approaching what happened in the 1970s. More of a, I think, 2031, you'd be at about $150, $160 oil. Which is not more than $10 above where it was in June of 2008, by the way. So that would be a nice increase. But if oil gets there, energy stocks will do quite well. And I think they are a good hedge, yes.
And just real quickly, we only have about a minute left, but I am curious about sort of when you look at economic conditions overall, Barry, everyone kind of wants to know where we are in this cycle, whether we're still have some sort of recession looming over us here. How are you positioning right now around those economic conditions?
Yeah, we continue, ever since last October, we continue to be in cyclical over defensive and now more so value over growth. And that would be your traditional cyclical value. So we're talking energy, industrials, financials, basic materials, real estate. We think there's a little bit left there because you're going to have no real near-term falling apart of industrial production, purchasing manager index, or GDP, and no major spike, but then also no major drop in inflation. So sticky inflation with better growth puts you in cyclical value, which is the sectors I just mentioned.
All right, Barry, always great to catch up with you. Barry Bannister over at Stifel, the chief equity strategist there, helping us count you down to the closing bells, which are just about 2.5 minutes away here, Scarlett. And the market here trying to hold on to some of those gains that it really just kind of found over the last 2 to 3 hours.
Yeah, it was kind of a straight shot up after Jefferson began speaking, the Fed vice chair. Of course, most sectors in the green right now, led by energy as oil prices continue to move north.
Yeah, and of course, a lot of the defense contractors moving higher as well. The top 5 stocks in the S&P, all in the defense space as we move closer to those closing bells. Stick with us. Full market coverage coming up right here on Bloomberg as we take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Scarlett Fu. We're counting you down to the closing bell, and here to help take us beyond the bell. It's a global simulcast with our friends Carol Masser and Tim Stenovic. Welcome to our audiences across our Bloomberg platforms here. A look at the broader market right now with an eye, of course, on the bond market, which is closed. Equity market's still open, Carol Masser, and they're green pretty much across the screen.
Yeah, pretty remarkable. And if you dig into the major industry groups, I know we'll talk about it, but you are seeing, certainly some buying here on this day when we're thinking a lot about what's going on in Israel. Having said that, and we talked about this earlier, right, Tim? I mean, some groups, whether it's defense or airlines are down almost 4%, as you see. Certainly the U.S. majors and other carriers, certainly around the globe, but are canceling flights into Tel Aviv airport.
It was pretty surprising to see the turnaround today that we saw in U.S. equities. But I think, Scarlett, it's fair to say that, instead of taking cues from the conflict right now in Israel, the stock market is taking cues instead from Fed speakers who said, maybe it's time for us to take a step back and pause and see what happens with high rates.
Yeah, dovish Fed speak kind of saves the day for equities, but if we're going to take a step back and see what happens, it might just be oil staying higher for longer and perhaps that bleeding into all the other inflation measures that the Fed does track.
Yeah, and of course, we get a lot of inflation data, of course, this week, including the CPI numbers. And more importantly, we get a start to an earnings season, maybe not with the banks, but certainly when you get to the other names, you'll find out just how much inflation is biting and just how much they've been able to push back on it by passing on some of those things to consumers. Let's walk through the numbers here as we get the closing bells here on this Monday afternoon, a day that started with most of the major indices deep into the red, turning into a day where most of the major indices solidly in the green. A Dow Jones Industrial Average up of roughly 190 points, or about 0.6%. An S&P 500 up almost 30 points, or about 0.6%. The Nasdaq Composite higher by more than 50 points, or about 0.4%, while the Russell 2000 putting in a pretty decent showing today, a 0.6% gain here for the small cap index.
All right, we're going to get into the major industry groups in just a moment, but looking at the S&P 500, most of the names in the index, 351 to be exact, higher for the Monday trade, 147 to the downside, and Scarlett, we've got about 5 unchanged here.
Yeah, let's take a look at the sector performances as well. If you split the S&P 500 up into 24 industry groups, energy stocks leading the way, up 3.5%, with all members, all 23 big cap energy names in the green. Capital goods, Romaine mentioned defense companies. Those are the defense companies that's pushing up that sub-index. And telecom services up by 1.7%. On the flip side, the decliners include household and personal products, or traditional defensive groups, and chip makers off by 0.4%. But these are fairly small losses in contrast to the gains among the best performers.
All right, guys, let's get to some of the individual gainers for the Monday trade. And certainly this has to do, I kind of did a split here. These are certainly names that are moving on that attack into Israel. And we talked about it earlier, and we've been talking about it throughout the day. Of course, the energy names, they are certainly outperforming, and concerns about maybe longer-term supply issues. ExxonMobil up 3.4% in today's session. On the other side, you've got the defense names. They are certainly gaining in today's session. Again, concerns about could we have a longer conflict in the Middle East, or a broader conflict, and what does that mean potentially for increases in defense spending? So you've got something like Lockheed Martin. That name is up, about 9% here as we speak here at the close. Then I wanted to go to 2 names that are kind of beyond the conflict, if you will, and Disney among them. I know you guys were talking about it on TV. First reported in the Wall Street Journal, Nelson Peltz seeking several board seats at Disney. He boosted his stake in the company. He now has more than 30 million shares, according to those people who are familiar. It's worth about $2.5 billion, so it would make him one of Disney's biggest investors. So that's going on. So Disney up about 2% in today's trade. And Weight Watchers, interesting over the last month or so. Weight Watchers, of course, now known as WW International, rallying. This one is up.
This was called because Oprah spoke out of turn or something.
Yeah, apparently back on September 20th. She's a shareholder, as you know. She's a board member. And she said at a panel discussion that she refused to take one of these GLP-1 weight loss drugs. So you're talking about Ozempic and Wegovy, and saying that this would be the easy way out. Well, the stock tanked on that because, as you know, WW, this is a big part of their strategy, these weight loss drugs going forward. Well, apparently she clarified what she said, and she said, just clarified it, and I guess kind of calming everyone down anyway. WW shares up about 13% today.
I didn't know all that about what Oprah had said recently. So that is an interesting.
What Oprah says.
You got to keep up. You don't have your alerts on your phone.
I don't. I don't. I mean, she's been a shareholder in that company for
Jefferson,
years.
Mary Daly, Oprah.
Morgan Stanley also had some upbeat
Fed
comments,
speakers,
I should say, too.
the Fed speakers and Oprah certainly. Hey, I got the decliners today. I want to start with the worst performer on a points basis in
Tim
the S&P
doesn't read
500.
People magazine. That's what I'm thinking.
NVIDIA,
anyway,
that company finished the day down by just 1.08%. Semiconductor stocks, though, from NVIDIA to Applied Materials, they did fall today over concerns about the possible impact on Intel's plan to build a new manufacturing plant in Israel. Earlier, Prime Minister Benjamin Netanyahu had placed the deal's value at $25 billion. This plant by Intel and other chip companies as part of a diversification of their production sources. And then the airlines, United Airlines Holdings, all airline stocks, all big airline stocks, I should say, slid on Monday after some companies halted flights to Israel. And of course, oil prices moved higher as well. Delta, United, American shares all fell. United had flights to Tel Aviv from Washington, Newark, Chicago, San Francisco. The head of American Airlines Pilots Unit said that members shouldn't fly to Israel until the situation is safe. Shares of airlines moving lower on the day as well. Royal Caribbean Cruises. This is an energy story, but it's also a story about a couple downgrades or price target cuts, I should say. Royal Caribbean moved lower after the company got a couple of price target cuts from Wall Street analysts over higher fuel cost estimates. Barclays and Wells Fargo both cut their price targets on the company's stock.
All right, let's check in on what's happening in the Treasury space. It is the Columbus Day / Italian-American Heritage Day here in the U.S., and of course that meant bond markets were closed, though we should point out that some of the main ETFs that take in, that actually invest in bonds, those were actually trading. In fact, TLT, the main ETF tracking the long bond, actually had its best day going back to late August here. And it gets to this idea, guys, of some of the comments that we have heard out of the Fed members, whether it was Mary Daly last week or Philip Jefferson today, this idea here that the markets have done a lot of the heavy lifting for the Fed when it comes to tightening financial conditions.
So that's it? We're done?
Maybe.
We're done with rate hikes?
Mission accomplished.
Okay.
Yeah.
Well, it does speak to the point of a lot of people thinking that perhaps 10-year yields have peaked. Barry Bannister of Stifel was just on saying just that. And a lot of people pointing out that volume in TLT last week reached the high since March of 2020. So that idea that people have been pulling out or piling in, we have reached that moment, and now it's the aftermath. Of course, there's a lot of issuance coming out this week, too.
No, that's a really good point. And I guess I would argue that, man, I feel like we've had this conversation, oh, rates are peaking, and then we kind of got fooled again. And I am curious in terms of the inflation prints this week, if they come in hot or start to stoke inflation concerns about it just continuing to be sticky, do we kind of have another rethink about what the Fed might do? What?
Well, I was going to say real quick, though, but I think Barry's point, though, too, and a lot of people other made this point, is you have to look at the differential with where the inflation rate is, depending on which one you want to pick here. And, we're basically above that when it comes to the Fed funds rate, Treasury rates, and where that inflation rate is. So in theory, if you just do basic economic theory, then that would mean the Fed should actually stop.
Okay, but at the same time, we're getting blowout job numbers like we got on Friday, and analysts who are surveyed by Bloomberg, economists surveyed by Bloomberg, think that CPI year over year is going to be 3.6% on Thursday. So we're still well above where the Fed thinks that things should be.
And oil prices are elevated and may stay elevated for a while now, given the events of this past weekend.
Yeah, it's a tricky call, I will say. But if the Fed is even a little bit nervous about inflation not really under control, right? Yeah. Do we assume that they're going to raise rates again? I just wonder what the think is. Are they worried about overdoing it or underdoing it at this point?
I love when you sit back and you do that little head thing, because that's when I know she's really trying to say something important here. For our radio audience, have no idea what I'm talking about here. But in all seriousness, though, but this goes back to the idea. If the market is doing doing a lot of the work, and they have. And in fact, you've had economists even argue that a lot of the disinflationary trend we've seen is actually more from the supply side, meaning things that were outside the purview of rate hikes to begin with, that maybe Philip Jefferson, maybe Romaine Bostick, some of the comments they've made, they're right, that this is more of a wait and see rather than, oh, let's go into this meeting at the end of the month and think about whether we should hike or cut. Well, maybe just do nothing. How about not have a meeting?
Well, then what are we going to talk about?
I don't know. We could talk about something else, something bright, something fun.
The wait and see, though, doesn't necessarily mean,
a
reminder, it doesn't mean cutting rates. I mean, higher for longer is what we've been talking about. So, just because the Fed may not raise rates another time this year doesn't mean we're not going to be in a high interest rate environment for a significant period of time.
I also do wonder if the Fed's saying, we got 2 meetings, guys. If we want to take a pause again, why not? And then we've got December, and then we can kind of see what the new year
And the
brings.
Fed isn't beholden to those meetings. I know we make such a big deal about these hard dates.
It does feel like they are.
But the Fed could do whatever they want any day of the week, and they have in the past. I mean, obviously, maybe this situation doesn't rise to that emergency level, but it's not like they're somehow beholden, like, oh my God.
But they don't do that anymore. Remember,
like
I think about that. They used to be able to surprise the markets, and when's the last time they did that?
They did a surprise rate cut during the pandemic.
Well, they did it during the pandemic, so it wasn't that long ago.
Yeah.
So extreme circumstances can do that. And Carol, you have to stay in the shot here. You're confusing me. But yeah, they can do it. And so if they feel like somehow they're behind the 8 ball, then they can always say, okay, you know what, we made a mistake.
But a surprise move would shock the market.
Probably.
Right?
Probably.
So if they really need to do that, then maybe they'll do it. All right, guys, we got to run. Obviously, a lot to talk about this week. We're going to be on all of it, the markets, and of course, what's going on overseas in Israel. So stay with us, everybody. As always, our cross-platform on radio, TV, YouTube, and Bloomberg Originals. We will see you, the whole team, tomorrow.
Stick with us. A lot more coverage coming up here on The Close on Bloomberg Television. Going to go overseas, spend some time talking about what happened in Israel as well as what happened in China over the weekend. Xi Jinping actually meeting with U.S. senators for the first time since 2015. Mary Lovely over at the Peterson Institute, she's going to give us some insights here into the significance of this meeting and, well, I guess whatever progress might have been made. That conversation and so much more coming up in a bit. This is Bloomberg. The drumbeat of Fed speak that we've had over the past few days actually seems to be singing from the same hymnal book here. The idea that the Fed can maybe stand pat. The idea that they can basically be cautious, be careful, not make any big moves, given a lot of the work that they've done, but more importantly, a lot of the work that the market has done for them. That gave a little bit of a boost to stocks, which started the day in the red, but as you can see, finished pretty strongly here in the green with the S&P 500 up by about 0.6%. Similar gains for some of the other major indices here on the day. We should point out it is a bit of a holiday here in the U.S., so you saw the bond market close. The ETFs that track the bond market were open, and you saw a lot of activity in that space. TLT, the main ETF tracking the long bond, having its best single-day gain going back at least to late August here. You also saw defense stocks get a strong bid here, coming off the horrific news that we learned over the weekend about the attacks in Israel. Every defense contractor here in the U.S. as well as over in Europe got a strong bid on the day. We're talking 8, 9, 10 percentage points for names like Lockheed, General Dynamics, and Northrop Grumman. At the bottom of your screen, that is the Israeli benchmark. It did rebound a little bit after that brutal sell-off over the weekend. Meanwhile, you also saw oil and gas stocks get a bid on the potential for disruptions in the Middle East on oil and gas supplies should this war actually escalate even further. And airline stocks took it on the chin as well, as most airlines now have effectively halted any sort of traffic coming in and out of Israel. That could be a big concern for some of the international carriers that do rely not just on those routes to Israel, but some of the neighboring nations that also served as hubs like Turkey and others. Solar Edge and Teva, two of the names with deep ties to the Israeli economy, both on the back foot today. In fact, most of the major stocks listed here in the U.S. or ADRs here in the U.S. that are affiliated with the Israeli economy were down significantly here on the day. But go back to the macro for just 1 second here. We did get the latest CFTC data, the big batch on Friday, and it showed what we've known for quite some time. A lot of folks now starting to pair their shorts in the equity market and adding to their longs, Scarlett, in the dollar.
Yeah, the dollar continues to build on its recent strength, and something we'll continue to monitor here as we monitor the developments overseas. Meantime, a Harvard professor has become just the third woman to win the Nobel Prize in economics. Claudia Golden received the honor for her work researching employment and pay gaps between men and women. Here now with more is Nabila Ahmed. She is Bloomberg News' team leader for our equality coverage. Nabila, welcome back to New York.
Scarlett, lovely to be here.
So give us some of the conclusions that Claudia Golden came to in her research on pay gaps between men and women.
So Claudia Golden looked back towards more than 200 years of labor market data in the US and found that when it comes to the gender pay gap and women's underrepresentation in the labor market, it's not just about the economy and the workplace, but it's also about what's happening at home. And she came up with the first comprehensive picture of what that looks like. So she found that there is a bit of a cliff for women who have children. So right after women give birth to their first child, they drop off in pay, even for the same roles, and even for roles that they were getting the same pay as men prior to having children. So she calls it this penalty that women are paying, and that's exacerbating the gender pay gap. So industries that have greater flexibility have managed to narrow that gap.
Give us a sense here as to why this was so important, because everything you just said, I think, would just be common sense. But of course, as we know, it wasn't either common sense, or at least it wasn't applied in any sort of common sense way.
It's the first time that someone's actually drawn together all those different elements of a worker's life. So we've had many economists over the years look at work and through the lens of what is happening in the workplace, but to tie together what is happening in someone's life and what is happening in that moment in history, that is something that's groundbreaking.
Go ahead, Scarlett.
Oh, no, I was going to say it's also notable that this happened 2-3 years after the pandemic with the debate over hybrid work or remote work, because as we know, a lot of women need flexibility for their work lives in order to be able to take care of things on the home front and at work.
That's right, Scarlett, and that's why we saw earlier this year US women's labour market participation at record levels, because of some of those post-pandemic or pandemic era flexible work arrangements were still in place, and that has really helped women bridge that gap. But we're talking about a huge gap here. Globally, only 50% of women are in active work or seeking paid work versus 80% of men. Yeah. And our own Bloomberg economists have estimated that closing that gap could generate $20 trillion for the global economy.
A big part of the research, though, was that this idea as well, that the idea that women and their primary role was in the home, that was kind of a fallacy as well, that when you go back in history, that there were so many examples at least prior to the industrialization era, where women were just as much of a component of breadwinning, for lack of a better word.
That's right. Yeah. You know, before industrialization, you had women working on farms, and that may not have been paid work, but that was contributing to the economy. Post-industrialization, some of those rates fell off, but then once we moved back in towards a service economy, rates went up again. I mean, she looked at some industries like pharmacy, for example, which used to be very much run by independent pharmacists, and you had to be on call. But since drugstore chains started taking those over, it was more able to be substituted, and you didn't have to be on call anymore. So the gender gap there is very minimal.
What economists or what kind of work has been inspired by what Claudia Golden has found? I'm just curious what legs her work has in terms of new questions being raised in economics.
We've seen a slew of women economists come out today and say how much she has inspired their work. But the economics remains a very, very male-dominated area. Yeah. And they're talking about her breaking some of those barriers and maybe paving the way for future economists.
All right, Nabila, this was a great conversation, and obviously a very historic day for a very deserving person here. A conversation, of course, about the latest Nobel winner for that economics prize. I'm always confused by this, Carley, because they always say it's not technically a Nobel Prize, the economics prize.
Yeah, but it's just kinda, that's the shorthand.
I mean, who's going to quibble with that, right? I mean, I've never won one. Have you?
No, still waiting. We're both waiting.
We got time. We're still young. All right, a lot more coming up here on the program. We're going to focus on what's been going on with some of the commentary out of Fed officials and how the bond market is doing their job for them. That conversation coming up after the break. This is Bloomberg. Breaking news. news involving the situation in Israel. We're learning that more airlines have suspended flights. Delta Airlines, which had already grounded all flights in and out of Tel Aviv, says that suspension will last at least through October 31st. We're also getting some commentary right now out of the President of the United States, Joe Biden, saying, confirming that at least 11 Americans were killed in that attack in Israel, and that he's directed his team to work with his Israeli counterparts, and he will, quote, make sure Israel has what it needs to defend itself. Scarlett.
Okay, we will continue to keep an eye on all of those headlines. In the meantime, Romaine, we've got to talk about what's been going on in the bond market, because 3 Fed officials have now said the rise in Treasury yields are doing the work for them, and further rate hikes may not be necessary. Let's discuss all of this with Bloomberg's chief correspondent of global macro markets, Liz McCormick. And Liz, the 3 Fed officials who are speaking, one is of particular importance, and that is the Vice Chair Jefferson.
Yeah, and he came out this afternoon and said, after Lori Logan from Dallas Fed, not that she's not important, but vice chair is always a little bit more important to the marketplace. Yeah, trumps a little bit. And he said, yeah, they're watching to see how much the rise in bond yields is a bit doing their work for them. You know, it depends, right? Because if bond yields are rising because the marketplace thinks the economy is very strong, well, then that's kind of not good for the Fed, because, you know, they don't want the economy to be so strong. I mean, they're trying to slow down demand. But if bond yields are just rising for other forces, like Lori Logan laid out, maybe term premium, just the risk people see in the marketplace, something we've talked about with supply issues, then that is creating more of a tightening of financial conditions. So the market really, I mean, we did have futures open today, even though the cash market was closed, and they moved to the day's high after Jefferson spoke. So I think it's important. It has people thinking maybe they're done, you know, odds of a hike for November now, like 20%. You know.
Yeah, it moved, and this creates a drumbeat to when Jay Powell does speak next, what he might shed in terms of light on where he sees things headed with yields where they are right now. There's going to be a lot of supply coming this week, too, isn't there?
Right. We have a lot of auctions. You know, these are not like, you know, new auctions as far as a new refunding, but they're the ongoing auctions that we already had on the schedule. So you have the supply, we have the CPI number, which, you know, someone was saying to me earlier that if CPI is just right on the money, it doesn't have to be stronger, that, you know, that combined with the jobs data shows a pretty, you know, strong environment. Inflation is coming down, but, you know, still too high, and jobs are strong. So, you know, the Fed is still going to be deciphering how much tightening do we have to do? Did the bond yields do some of it for us? And then we have all this supply, which finally, for once, it's like supply is my jam. And at times it doesn't matter, but it seems to be mattering more because the fiscal backdrop is not getting any better. Yeah. And, you know, demand, some of the kind of less price sensitive buyers are kind of faded to the woodwork.
All right, so some of these Fed members seem to be patting the bond market on the back. Is the bond market accepting this? And I ask that because I am curious about the difference between the activity we saw on the shorter end of the curve versus the longer end of the curve, because it seems like those trades aren't necessarily trading the same thing, if you know what I mean.
Right. It's kind of weird, Romaine. We have this, what I keep calling, some people have, it's like a unicorn that we have a bearish steepening, right? Okay. That means yields on the long end are going up faster than the short end, but they're all going up, like you said. So I think people feel like maybe the short end is locked because if the Fed is at least close to done. But these long-term rates, that's where kind of the pain trade comes in a lot.
Yeah, well, because the short-term rates actually seem to be a little ahead of the Fed to a certain extent. Not necessarily so on the long. I mean, the long end just all over. It's just like one of those squirrels when it gets caught in the middle of the intersection, doesn't know which way to go.
Right. Plus, like Chairman Greenspan in the old days learned that conundrum that the Fed doesn't have total control over long-term rates, right? Their quantitative tightening or quantitative easing does affect them, but they're moving on other factors. So, you know, in some ways they have, that's their control, the short end. So I think people feel like, you know, steepening of the yield curve was going to come. Most people didn't see it with all yields going up, so that's been tricky for people to digest.
And steepening of the yield curve after a period of inversion, for a lot of people, it means what? The recession is getting actually closer, right?
Yeah, that's the kind of in the zeitgeist now. Does that mean the recession's getting closer, especially as yields are going up overall, you know? So that's pain to the economy, to consumers who have to, you know, go out and get a car loan or want to get a new home. So I think that's the thing. The flag is the inversion, but this kind of disinversion heading towards flattening has some people thinking maybe then the recession is finally going to come.
I am curious here. I mean, I'd be remiss in not asking you about the situation in Washington with regards to fiscal policy or the lack thereof here. Do you think that this could be have a material impact on the Treasury market, assuming that we get to this mid-November date and for whatever reason Congress still hasn't gotten its act together?
Well, so it's two ways, right? One is that if we do get a shutdown, the economy should slow. I mean, all the Wall Street analysts have done their forecasts of it's like 0.5% maybe GDP for every certain length of the slowdown because certain things aren't running. You can't go to the national parks. A lot of them are closed and that kind of thing. As far as the dysfunction, you know, we have one more rating agency that hasn't downgraded the U.S. That might do it. You know, they've talked about it. I don't know that the market's going to so react to that, but it's not good. You know, it's not good to have this ongoing dysfunction. We don't have a speaker right now. There's no kind of resolve to deal with the deficit and narrow it. So I think it doesn't help. But if the economy slows, that may be kind of take the heat off bond yields a little.
All right. Well, the picture is not very pretty nonetheless. Liz McCormick, thank you so much. Bloomberg's Liz McCormick joining us here on Yields. Now, coming up, a historic meeting in China between a group of U.S. senators and Chinese President Xi Jinping. Mary Lovely, the senior fellow at the Peterson Institute for International Economics, gives us her read on what happens next. This is Bloomberg. All right, let's get to the latest from the White House, which just issued a statement a few moments ago. We're going to check in now with Balance of Power co-host Anne-Marie Hordern for more. Anne-Marie, what did President Biden say?
Well, we have this statement released from President Biden himself, and he talked about the death toll of Americans that died in this massacre over the weekend with Hamas infiltrating Israeli territory. And he says the American death toll is at 11 right now. He also talks about the fact that there are Americans unaccounted for, so this death toll could potentially rise. He also says that they are still working to confirm, and we believe it is likely, as the president's statement, that American citizens may be among those being held by Hamas. And the president talked about the fact that he's directing his team to work with their Israeli counterparts to make sure they can find these Americans. The president also talked about the unwavering commitment and his phone call with President Netanyahu about the ironclad unwavering commitment the U.S. has to Israeli defense.
Anne-Marie, thank you so much. Thank you for giving us that recap. And of course, check in with Anne-Marie Hordern at the top of the next hour for Balance of Power. In the meantime, we want to continue the conversation and discuss the situation in the Middle East with Bobby Ghosh. He's Bloomberg Opinion's editor. Previously, he was Time Magazine's international editor as well. Bobby, great to see you here. I know you've written about the rise of Hamas to become the principal exponent of violence against Israel many times in the past. And in recent years, we've really seen Hamas's focus be on the West Bank. But in this weekend attack, they struck Gaza. What does that tell you?
Well, it tells us that Israel was taken completely by surprise. This is not something that was sort of planned and executed overnight. This was weeks and months in the planning, and it basically tells us that Israel's intelligence system, which is prized as one of the best in the world, basically completely and utterly failed in this instance. Israel was looking in the wrong place, the West Bank, to your point. It was not paying attention to Hamas in its traditional base of Gaza, which is where the attacks came from. A massive attack, not through the traditional means, which is tunnels underground, but over the ground and from the air. This took Israel and the wider world completely by surprise, and it changes realities on the ground right now and going forward.
It certainly does, and we should just point out in fairness, in addition to it being a failure of Israel's intelligence, you can make an argument that it was a failure of some of its Western allies as well.
Oh, yes.
We know the U.S. as well as Europe have been very involved here in supplying intelligence, and it gets to this idea here, not only as to why they did this attack, but how they were able to pull this off. I know it's a little bit too early to speculate, but this doesn't seem like it could be 100% homegrown.
No, we've known for years that Hamas gets money, gets weapons, gets training, gets encouragement, diplomatic cover, all sorts of things from Iran. It also gets a lot of support from Lebanon, specifically from Hezbollah, which is another arm, if you like, of Iran's sort of network of proxies.
Yeah.
So Iran's fingerprints are all over this. Whether or not Iran actually planned this operation or gave the final go-ahead.
Right.
We don't know. We'll find out. We wouldn't be surprised if that were true. But at the moment, all we can say with certainty is that there was substantial Iranian involvement. That's not a great mystery.
The question, though, becomes what the response is going to be. I mean, going into Gaza, the West Bank, as Israel has done plenty of times before. I mean, I hate to say it, but we've kind of become inured to that to a certain extent here.
Yes.
Waging any sort of direct military confrontation with Iran and even Lebanon to that extent, that would be a huge game changer if it would happen. And I guess, do you think there is, A, the political appetite, both in Israel as well as with its allies, to actually do something like that, should they find enough evidence to justify it?
Well, at the moment, there's no sign that anyone wants that to happen. In fact, both the U.S. as well as Israel has been bending over backwards a little bit to say we have no smoking gun linking to Iran. And that's the narrative that suits everybody at the moment. Nobody wants to see a direct confrontation with Iran, especially with memories of what happened in Iraq so fresh in our minds. But if a smoking gun is produced, then that will bring a lot of pressure, particularly on Prime Minister Netanyahu, who has for years and years and years been warning about the threat from Iran. If that threat finally is proven, then he will be under enormous pressure politically and from his own people to do something about it rather than just engage in another round of verbal sort of
particularly in light of the new coalition that he's trying to pull together, which is made up of a lot of far-right hardliners who got him back into office.
That's exactly right. Far-right hardliners. And the nature of this particular attack from Hamas, aiming at civilian targets, that music festival, the grisly, gruesome images that we have seen. This is terrorism, pure and simple, and it will invite an attack.
So, Bobby, as a longtime observer of the Middle East, what does the world not yet realize or understand about this conflict in the coming days and weeks and perhaps months?
Well, the world has no excuse not to know what's going on. It's been going on, as you say, for a very long time. But large parts of the world, in Europe and other parts of the world, have been reluctant to put the label of terrorist on Hamas. They've tried to portray Hamas as a resistance group, perhaps a little more hardline, perhaps a little over the edge compared to other resistance groups, but let's not call them terrorists. That's been the position in large parts of the world. It's a little hard to sustain that argument anymore when they have so clearly targeted civilians and the atrocities that we have seen, the women taken captive and stripped, the elderly Holocaust survivor being taken and held. It's no longer possible to apply that little fig leaf of resistance on Hamas. This is a terrorist group, pure and simple.
All right, Bobby Ghosh, who writes for us here at Bloomberg Opinion. Always great to get his insights here. We want to keep the conversation going with the focus on what's been going on overseas. There was also over the weekend a historic meeting in China between President Xi Jinping and a bipartisan group of U.S. lawmakers led by Senate Majority Leader Chuck Schumer. Schumer telling Xi that he was, quote, disappointed by China's response to the conflict in the Middle East. Take a listen.
I also made a request, a direct request to President Xi, that the foreign ministry strengthen their statement on the Middle East, which didn't even mention the loss of the horrible, gut-wrenching loss of civilian life. I'm gratified the foreign ministry issued a new statement that did condemn the loss of civilian life.
And that is Senator Chuck Schumer, the Democrat from New York, the Senate Majority Leader, talking about his meeting with Xi Jinping. Let's get some insights out of our next guest, Mary Lovely, Senior Fellow at the Peterson Institute for International Economics, joining us now. And Mary, I want to get into a little bit broader discussion about the relationship between the U.S. and China, but I do want to start first with the criticism that Chuck Schumer seemed to level against his Chinese, the Chinese officials here for not making a more forceful statement condemning the attack in Israel. Mainly because I'm just curious as to whether this is kind of China's thing. And I raise that because I felt like there was a lot of pressure on China to say something about the war in Ukraine. There was a lot of pressure on China to say something about other international conflicts. And they seem to have made a habit of, if not speaking out, certainly just kind of, giving you a little bit of lip service and then turning their attention back to what they do best.
Yeah, this certainly has echoes of the Chinese approach to the Russian aggression in Ukraine. And it is the way that China has chosen to handle these diplomatic events, sort of soft walking the real atrocities that are happening on the ground. I think it belies their relationships, on the one hand with Russia, on the other with Iran. In this case, we did see some backtracking in that the foreign ministry issued a revised statement. The Chinese UN ambassador explicitly discussed civilian casualties and that China condemns them. So there has been immediate pressure on China to go further, and they have gone a bit further, perhaps not as much as the United States and many others in the world would have liked.
Well, one reason why I was interested by this is because we've seen in the past how Chinese officials have kind of bristled anytime the U.S. sort of makes demands, primarily on these types of things, the idea that they should take this stance. And usually the response is, you know, China has its own position, you have yours. And I'm curious as to whether this becomes an impediment to normalizing, or I guess improving relations, I should say, between the U.S. and China. A U.S. government that, let's face it, for better or for worse, likes to impose its own moral principles on other nations, for better or for worse.
Well, it is an impediment for sure, Romaine. In the Ukraine-Russia conflict, we've already seen it as an impediment to improved U.S.-China relations. In this case, we have seen Chinese exports to Russia increasing as China has been sanctioned by the rest of the world. And that clearly has been an impediment to not only improved U.S.-China relations, but also to Chinese-EU relations, which really have been hurt very badly by their unwillingness to speak out more forcefully and directly about the Russian aggression.
Mary, can we or should we read China's toughening its statement on the attack in Israel as indication that maybe there were some productive discussions with the senators and the members of Congress?
Well, I wouldn't overread what we heard. I think that they realized that they were going to be faulted, not just by the United States, but by many, for a failure to do what is a seemingly easy act, which is to condemn acts of violence against civilians. So I think that we don't want to overstate the impact that the delegation has had. I think, unfortunately, this has taken attention off of what we hope are the discussion of economic issues, which were central to the delegation, their mission going there, and in particular to the things that Senator Schumer hoped to accomplish in these meetings.
So that brings us to the next point, which is this visit was meant to help set up President Biden, or I should say President Xi's visit to the U.S. for the APEC summit in November in San Francisco, and eventually meet with President Biden at that time. What kind of groundwork does it lay for that possible meeting?
Well, I think, you know, the Chinese are a full understanding of the role that the U.S. Congress plays in U.S. trade policy, U.S. industrial policy. And Senator Schumer also wanted to assert the influence of the Congress and let the Chinese know what Congress is thinking. The Congress has taken a rather hawkish turn toward China. And this was a bipartisan delegation of senators. So Schumer was making clear to the Chinese that both sides of the aisle have issues with China. Top of mind for Schumer, of course, was boosting U.S. exports into China, making sure that China protects the legitimate business rights of U.S. businesses operating inside China, and also something important to Schumer, which was seeking better Chinese action on reducing the flows of fentanyl into the United States.
When it comes to, I guess, the areas of actual compromise, meaning the things that we maybe potentially know China would be able to acquiesce to here, is there anything major that jumps out at you?
Well, clearly the Chinese are able to do something about the flow of fentanyl. They have in the past. And it seems something that they could do if they wanted to offer some kind of legitimate olive branch to the U.S. I don't think either side came to this meeting expecting much action as a result. There are no real offers on the table. Instead, they are seeking to explain rather than ask any kind of permission or get any kind of deal. And as we've said before, in the visits of the three U.S. secretaries to Beijing, we are glad that they are talking. They're trying to seek a way to move forward. And I'm sure that's what the administration is doing in preparing the groundwork for President Xi's visit to San Francisco later for the APEC meetings.
All right, Mary, great conversation. We'll catch up with you soon again, I'm sure. Mary Lovely, she's the senior fellow at the Peterson Institute for International Economics. Coming up here on the big program, we're going to talk a little bit more about politics and Kevin McCarthy hinting at a return to the speakership. That conversation coming up next. This is Bloomberg.
Has it been a week?
Not yet.
This is about a moment in time. This is about what America's going to do. I'll allow the conference to make whatever decision. Whether I'm speaker or not, I'm a member of this body. I know what history has had, and I can lead in any position it is.
Okay, well, about a week after being removed from the speakership position, Kevin McCarthy, representative for the district in California, hinting at a return to that House speakership to help, quote, destroy Hamas. Without a House Speaker, congressional aid for Israel and Ukraine is unclear. Ed Mills joining us right now. He's Washington policy analyst over at Raymond James. All right, this was a little bit of a head scratcher. I understand that sort of trying times often call for unique decisions here, but for a man who clearly didn't have the support of his party, or at least key members of the party, what has really changed, if anything at all, over the last week that would actually make them put him back into that speaker's chair?
Romaine, it's probably what hasn't changed, which is there's still no one candidate with a clear path to the 217, 218 magic number to become speaker. We have Jim Jordan in the race, Steve Scalise, the House Majority Leader. There's a hard group of people who don't necessarily want them. And so if that becomes deadlocked, that is the path forward for Kevin McCarthy. Now, one of my sayings about D.C. is that things appear impossible right up until the moment it's inevitable. And so if there is more pressure for the House to act on some legislative package, if there's more geopolitical pressure on the caucus to choose someone, the person that was speaker last week could once again be speaker next week. The final thing I'd say is you could also push to maybe give more power to the temporary speaker in terms of what can be done as they figure out who is the permanent speaker.
Well, of course, we need to frame this in the context of what happened over the weekend, which seems to be the opening that Kevin McCarthy is looking at. The idea that when you have these type of horrific events like what we saw in Israel, a major ally for the U.S., it does tend to bring a lot of us together here as Americans. I don't think that our divisions are going to be healed by this, but it certainly means that maybe at least on this one particular thing, Congress would actually act in the best interest of our national security. Do you think that could happen?
It is absolutely possible, Romaine, and I would look at some of the next fights. It looked last week that an aid package for Ukraine, additional defense spending, was on the ropes. Is the need to give more arms to Israel to fight back against Hamas going to cause a recalculation, especially with the involvement of Iran or a potential link to Russia? Those are going to be big parts of the conversation. Go a little bit further, November 17th. Are we willing to shut down the government? Are we willing to ask defense personnel to go without paychecks if they are in the middle of an armed conflict? I think that the expectation was that we could have a government shutdown. Those calculations also have to be changed. So things are being kind of recalculated very rapidly. And as I tell folks here at Raymond James and our customers, that things that seemed unlikely last week are really kind of moving very fast. We don't know exactly yet, but stay very close to the DC conversation because that has real market implications.
That's really important to hear. So do you think it'll be Republicans who are going to be shifting their mindset or Democrats as well?
Well, Republicans first have to choose a speaker. An option for Republicans is to reach out to Democrats. Is there a path forward for a unity candidate to become speaker? Ultimately, Republicans do have a majority in the House, so that is their job to choose a speaker, but it's not impossible. We see coalition governments across the country and state legislatures. Across the world, they are the norm. If you're not able to get to 217, 218 within your own caucus, there are 200 plus Democrats who are willing to potentially work with them. And as they relate to government funding, Ukraine funding, larger defense spending, there are a lot of Democrats. I'd say there's probably at least 80% of House and Senate members totally who support additional funding. That's what I'm paying attention to.
Okay, one thing we had talked about with Mary Lovely just now was about the U.S. and how it's viewing China in all this. I'm curious because every time there's an incursion somewhere in the world, Ukraine, now Israel, there are concerns that China may be emboldened to act on Taiwan. What is the conversation in Washington about that possibility?
Significant eye towards the U.S.-China relation. We're expecting as early as this week, we'll get additional tech restrictions on semiconductors and semi-cap equipment that's going to China. Does that flare things up? I think with the meeting between Schumer's led delegation and Xi, that's a positive sign near term. If we get those restrictions out this week and they're not as bad as feared, and the Biden-Xi meeting goes forward next month in San Francisco, that's a positive sign. And I'd also remind you, Biden and Xi are scheduled to sit down right at the same time. We have to fund the government. Going into that meeting, is the United States Congress going to give Biden the opportunity to go into that meeting with strength or chaos on the domestic front?
All right, Ed, going to have to leave it there. Ed Mills, Washington policy analyst over at Raymond James, giving some greater insight here into the Washington response to the crisis now unfolding there in Israel and in the Gaza Strip. Still ahead, we're going to set you up for what to watch tomorrow. This is Bloomberg. Let's push ahead to Tuesday and what markets are going to have their eye on them. We're going to start before the bell here in the U.S., Scarlett, with earnings.
Yeah, PepsiCo reports earnings. We'll get a read on consumer companies and how much pricing power they have right now.
Oh, I just want to know about Ozempic and Wegovy and how much that's going to actually ruin their forecast here, because apparently we're all just going to be skinny and not eating snacks anymore. Also, we haven't really checked in on the on the Sam Bankman-Fried FTX trial, but we're going to do that tomorrow because we're expected to hear Caroline Ellison testify.
Yeah, and of course she played a senior role in the firm, but also at one point was dating him too.
Thank you
for
that.
Good backdrop.
Yeah, good backdrop. A lot of context there. I'm not sure what the context is for this, but we get a lot of Fed speak, Scarlett. Bostick, Waller, Kashkari, and Daly are scheduled to speak.
And it's been sounding more dovish of late, especially given the relentless rise in bond yields lately.
And we talk about bond yields, but how about the sort of reopening of the IPO market? We're expected to actually get another one. Birkenstocks at the price
My favorite
tomorrow.
shoemaker.
Yeah, that's your favorite shoemaker?
My favorite shoemaker. All my shoes are Birkenstocks.
All right, and of course we will all day long, all week long, until it's over, we'll be keeping an eye on the situation in Israel. Balance of Power is coming up next. They're going to have a lot more coverage on what's going on over there in the Middle East and the response here in Washington. This is Bloomberg.